Welcome to Yahoo Finance's special coverage of the December jobs report. I'm Shauna Smith alongside Brad Smith, and we are just minutes away here from that December payrolls print, estimated to come in at 165,000. Beyond that headline number, a couple of the key data points that we will be looking for, of course, unemployment rate that's expected to hold steady at 4.2%. When you take a look at average hourly earnings on a month-over-month basis, that is expected to cool just a bit to 0.3% increase. That's in comparison to the 0.4% rise that we saw in the prior month's reading on a year-over-year basis. We're looking at it to essentially rise 4% on a year-over-year basis would be in line with what we heard last month, Brad. And of course, when we take a look at this print, the question that many investors are going to be asking is how the Fed is reading into these numbers and ultimately what it means for the Fed and their policy path going forward.
Yeah, keeping a close eye on futures heading into this print. This could be a big one, especially given that it will be the final for the Biden administration, but essentially really set the tone for the rest of 2025 as well here, especially with the implications that you were mentioning, and a Fed that has largely signaled that we're probably going to get 2 interest rate cuts this year, but you've seen a little bit more of the members that have started to make some commentary, even early throws of this year, say, hey, maybe December was actually the last one. And that, of course, certainly was something to note here for the markets yesterday, even though markets were closed. So we got some of that commentary, and we'll see exactly how markets continue to digest that with a bevy of other news here. And it comes off of a week where we've also got the JOLTS reports that came out. It's a big employment week here. We got the JOLTS report. We also got ADP private payrolls, and we were able to speak with the ADP chief economist, Naylor Richardson, as well, coming off of that print during Wealth, who gave us a little bit more of the downshift in the labor market commentary as well here. So it'll be interesting to see what this print holds for us coming in just a moment here. The December payrolls report crossing the wire right now. 256,000 jobs added during the month of December, higher than the 165,000 that was expected here. You also saw the average hourly earnings month over month come in line with expectations, 0.3% there in a rise. And then additionally, average hourly earnings year over year, that came in just a smidge lighter than expected there. It came in at 3.9% versus the 4% that was expected. And then the all-important unemployment rate figure, that came in better than expected, 4.1% versus the 4.2% that we were expected to see some type of uptick towards here. So ultimately, right now, it seems like the futures are continuing to react to this morning as we're taking a look, and we've got a full screen here for our viewers here, and the full screen of the futures here, as we were calling for as well. Moving a little bit more to the downside here right now.
Yeah, we're taking a leg lower on this very much stronger than expected print that we're getting almost across the board. When you take a look at that headline number coming in at 256,000, unemployment also falling by 0.1% down to 4.1%. Like you said, labor force participation, that's holding steady at 62.5%. So once again, a blowout jobs report here, especially when you compare it to what we have been expecting going into this print. I don't think necessarily a huge surprise that we are seeing a bit of a good news for the economy might mean bad news, at least here for the markets. Initially, it looks like the reaction here, and that was very much maybe what was expected heading into this print. So we're seeing all three of the major averages on track to open the trading day in the red. And when you take a look at the bond action, of course, the big question is what ultimately this means for rates. We have seen a massive uptick in yields here over the last several weeks, but in the midst of this bond sell-off, questions about whether or not we are going to cross that 5% level anytime soon. And again, when you take a look at the reaction here, we are seeing this move higher in yields. Well, joining us now to break it all down in studio, we want to bring in Steve Sosnick. He's the chief strategist at Interactive Brokers. We also have Greg Dacko. He's the chief economist at EY. Great to have both of you. Steve, you're sitting right to the right of me, and I heard you say wow under your breath when these numbers came out. How are you looking at this print?
Wow, is my first reactions. In my case, the reaction that fits here. I mean, the numbers. No one was really looking for a rise in payroll. It was just going to be how much smaller was it going to be than last month, and we blew it out. Looking at the 3-month revisions, it's 8,000, which means there's no funny business, at least in the very short term, going on here. The problem here now is if you are looking for rate cuts based on a weakening labor market, this fits in with the Fed rhetoric that we've heard. Stop looking for those. It's not going to happen, at least in the immediate term. And I think, unfortunately for stocks, the bond market doesn't like that. In theory, stocks should like a stronger economy. But in reality, what we're getting is an economy that seems to be keeping jobs in there. And I think, there was the hope that labor was going to get the Fed onto a more accommodative footing, and this doesn't do that right now.
Yeah, Greg, want to get your read in, especially as you're thinking about what this does signal for the Fed and how they could continue to look at this report, even going into the kickoff of their meetings for 2025.
I think it's the paradox of 2025. It's a robust but frozen labor market, one in which we're not seeing much churn in terms of the labor force. We're seeing very little entry into the labor market. We're seeing very little exit out of the labor force. And that is really the state of the labor market right now. It's reflective of businesses being very cautious as to their hiring needs. They're not hiring. The hiring rate is at a 10-year low. They're not laying off either. So you're seeing this steady but slightly cooling labor market trend, which is very encouraging from a Fed perspective. I think the attention will actually pivot back towards inflation developments over the course of the next 3 months, and I wouldn't be surprised that we see some positive inflation surprise with inflation moving lower over the first 3 months of the year on base effects, which could lead to a reassessment of the Fed trajectory by very reactive policymakers.
So what do you think that Fed trajectory looks like then?
I think they skipped the January rate cut, but they still proceed with a March rate cut. The trajectory after that will be highly dependent on policies that are put in place by the incoming administration, whether it's deregulation, immigration restrictions, trade, and tax cuts. All of those elements will influence the economy to a great degree, both inflation and the labor market, and that will lead Fed policymakers, whether they like it or not, to react to those policies.
What's the trade that investors that are firing up their laptops, their computers to a report like this morning should be making?
I think you go back. I think you start to look again at economically sensitive stocks because the economy in general is telling it you're pretty good. I do think you have to watch out for the bond market here. These are very worrisome signs, and we were supposed to go to hell in a handbasket if we went through 450. That didn't happen, fortunately. Then it was 470. Well, we're through that now for basically 4 3/4. Now they've moved the number to 5, where we should be getting worried. But I do think this is a fundamental issue here. Is we are getting stocks are getting some competition from rates. So I think being nimble and focusing more on economically sensitive names is the way to go here.
Do you think we're going to be reaching that 5% level likely in the next couple of weeks?
The bond market tends to move in big, long trends, like sort of 3 to 4 month trends. I hope not, but after a number like today's, it's hard not to say that we won't see a 5 handle on the 10-year. It's just the momentum is going in the wrong way. It's going in the wrong way internationally. UK and some other places, with the exception of China, where bond rates are basically approaching zero because their economy, is doing the opposite. I think in general, bonds have these. I'm not going to call them secular trends, but sort of if you look back at the charts, they move in a big direction for 3 to 4 months. I don't see anything right now. This number would have been the thing to break the momentum, and it hasn't.
How problematic, though, is that for equities over time?
The relationship between equities and bonds is a weird one, because if bond rates are going up because the economy is very strong, it's okay. Right, because that means that companies are making money, and that's really what it comes down to as an investor. Am I investing in companies that will bring me earnings, dividends, cash flows, et cetera? That's a good thing. If the bond rates are rising because of inflation fears, because of just general concerns, because of just general malaise, that ultimately does weigh on stocks. And so there is a number at which high bond yields become a problem for stocks, but it's a fluid situation, and it can be very dependent upon market psychology. I think back to when I started in the business, and I'm going to age myself here, and I started in 1987, which was one of the worst years in the bond market, and was one of the best years in the stock market until, of course, it wasn't. But that's kind of that relationship is always stuck in my mind, is that you can diverge for long periods of time, but a lot of it has to do with why. And
you'd mentioned that a lot of the focus might shift back towards inflation, and we have an incoming president that's talked a lot about what geopolitical policies, what tariffs could be added on, and what executive orders are starting to line up for day one, and even within the first seemingly 180-ish days of the presidency, we could see some tariffs get talked about, get implemented. How inflationary do you think that would be, and how much pressure do you think that would put on the wage growth picture as well here to continue to try and outpace some of that anticipated inflation?
I think what Steve mentioned is very important. We have to understand why the yields are rising, because we've had the Fed cut rates by 100 basis points, and yet yields have risen by about 100 basis points. So you've had massive divergence there. And I think there are a few factors that are driving this rise in yields. You have expectations of higher inflation with the policies that are likely to be implemented. Whether it's deregulation, immigration restrictions, trade and tax cuts, they are likely to be inflationary and push up the inflation premium in terms of bond yields. The other thing that we have to keep in mind is that they're also likely to lead to larger budget deficits. Going over the next 10 years, we're likely to be in an environment where the budget deficit is averaging around 6.5% of GDP for a decade. That's the type of budget deficit that you usually have in bad times. So we have fiscal sustainability concerns at the same time and a risk premium that's being added onto yields. That is why I'm a little bit concerned, because the higher we go with yields, the more of a risk-off environment you risk entering in, which would have a feedback effect on private sector activity and lead to a slowdown in economic activity.
You know, just lastly, while we have you, and this kind of picks up on something that we were talking about in 2024, were your thoughts around AI. And I mean, it's even made it into the conversation. I was at a musician's rehearsal last night, and they were talking about AI, and I immediately was just like, Allen Iverson, let's go. I've been waiting for somebody to ask me. And they said, no, artificial intelligence, it feels like it's coming for more jobs. It's making it into all of these kitchen table conversations, friends conversations, musicians conversations now. And you spoke to us about that last year. Is 2025 the year where we start to see the effects of artificial intelligence making its way into employment situation reports?
Not yet. I think it's going to take a little bit of time, but we are starting to see the initial investments in AI, and that's positive for growth, because we tend to always think about the positive spillover effects of stronger productivity growth. But the first thing you need with any technological revolution is investment in that technology. That's going to take a bit of time, but you're already seeing a lot of corporations invest in Gen AI and trying to increase efficiency in a high labor cost environment. That's what you're starting to see. You're starting to see these efforts at the corporate level trying to reduce labor cost via the inclusion of technology. I don't think we're ready yet to see it in the jobs report or in the productivity data, because that tends to lag a little bit, but it is underneath the surface something that's bubbling up and coming against an environment where productivity growth has been a key driver of U.S. exceptionalism.
All right, we'll get your thoughts on Allen Iverson next time. There will be no slander in that conversation. Steve Sosnick, Greg Dacko, thanks so much for taking the time
Thank you.
this morning. Appreciate it. Let's send it on over to our own Jared Blickry for a look at the movers on the back of the December payrolls report. Jared.
Brad, no doubt this is a risk-off movement that we're seeing in the futures. Here are the S&P futures behind me. You can see they are now down about 0.8%. Looking at the Nasdaq, that's down a little bit more, almost 1%. And then we have the Dow futures, and you can see almost all of this loss. And by the way, they're down about 72 basis points. Almost all of the loss taking place since that 8:30 a.m. report. They were just hugging the flat line there, the unchanged before that. And you can see this playing out in the gold market as well. We had a dip, although we are rebounding right now, so we're in positive territory with gold at $2,697 per ounce. We don't typically see a movement in crude oil. We'll get to bonds in a second. No movement in crude there, but we're even seeing a little bit of a downdraft in Bitcoin, and so that's something that's reemerged. I've seen that in Fed announcements and also non-farm payrolls of months past, but that's something that's happening today. But we got to get to the Treasury market. Here's the 2-year note future. So these move inversely to yield. So this means that yields are moving up on the 2-year tenor. And what was really striking here, we now have the 10-year futures. Those are down about 71 basis points. The yield, so this is moving up in terms of the yield. That is now at about 4.77%. That is about 4.75%. So that's kind of a psychological number. But this will definitely get the attention of traders. This is the highest level that we've seen in the 10-year in 2 years. So we're going to keep a close eye on that. We're also seeing things play out in the currency market. And I've been talking about the dollar wrecking ball. Here we have the euro, which moves opposite the dollar. This is moving down, which means the dollar is getting stronger. That's an additional headline on risk assets. And then if we go to the stock market, we can see the sector action playing out pretty negatively in the pre-market. The background color is what happened yesterday, but these little boxes is what's going on right now. You can see energy is now up 1.43%, so that's a nice pop for energy, but after that we got staples just barely positive, and it deteriorates from there. Real estate is now down 1.62%. Tech is down 1.25%. And if we take a look at the Nasdaq 100 components, we can see a lot of red in these little boxes. Again, the background is what happened yesterday, but here we're seeing Nvidia, which was almost flat yesterday. That's down 2.66% in the pre-market. If we take a look at the semiconductor space, we're seeing a lot of red in those little boxes, although Taiwan Semi up about 18 basis points there. And if we take a look at unprofitable tech, this is another area that has surged recently, so that's why I'm looking at it. We've seen money flowing into the little guys, but not today. We're seeing most of these names down. Roku is down 4%, Beam is down 3%, and the list goes on. So all in all, a pretty risk-off reaction to the report. I will say sometimes when the market gets started after the open, we get a nice reversal, and that could be in play too, but for now it's risk-off, guys.
All right, Jared, thanks so much for breaking that down. Coming up, we're going to have much more on the December jobs report and a look at what sectors gained and lost the most jobs in the most recent report. We've got that coming up for you next on Yahoo Finance. The U.S. economy adding 256,000 jobs in December. Unemployment ticking down slightly to 4.1%. Our very own Madison Mills and Alexandra Canal are joining us now for a deeper dive into the numbers, maybe underneath the hood of that headline number. Ali, I want to start with you. You're closely watching healthcare here.
Yeah, there have been pockets of the economy that have held up really well when we think about jobs added, and healthcare has certainly been one of those sectors throughout the course of 2024. In December, the healthcare industry added 46,000 jobs. Gains were concentrated in home health care services. That grew by 15,000. Nursing and residential care facilities, another 14,000 added there. And then finally, hospitals saw an uptick of 12,000. On average, this sector added 57,000 jobs per month in 2024. That matched the average monthly gain seen in 2023. Now, why have we seen this resiliency? A big reason is structural changes that we've seen throughout the healthcare industry post-pandemic. Hospitals relying less on temporary help, those temporary workers that were needed to fulfill a lot of those obligations with the pandemic. They're now relying on those full-time staffers. So if you're a nurse, if you're a healthcare professional, this is a good thing for you. We did see a decline in the office of dental workers by about 4,000, a decline of outpatient care centers by about 3,000. I know at least on the dental front, a lot of private equity firms are buying up those offices. But again, healthcare been very, very resilient so far this year, along with another sector in government jobs. big unknown with Trump taking office, the Doge initiatives. But those two sectors have really seen a lot of gains this year.
Yeah, it's interesting you mentioned healthcare. That was one of the common denominators between this print and the private payrolls report that came out earlier this week, which I know you're laser focused on, Maddie.
That's exactly right. Just to build off of what you were saying, Ali, I took a look at that headline number coming in, and then I subtracted the number of government jobs added this month to get a sense of the private payroll. So that private payrolls number coming in this morning at 223,000 jobs added. What does that tell us? It tells us that this jobs number was not really held up just by those government jobs. And that has been a huge question as we head into the Department of Government Efficiency, if you want to call it Doge, and whether or not a lot of job cuts coming into government specifically are going to be a headwind for the labor market throughout 2025. Today's report throwing a bit of cold water on that idea and that potential risk. The other thing from private payrolls that I wanted to point out is that we do have a little bit of a Goldilocks perspective here. When you take a look at average hourly earnings, in the headline number, they're coming up about 0.3%, but it's actually 0.28%. So heading towards that Goldilocks lift in earnings, which could be a less inflationary number in terms of private payrolls, fueling more spending from consumers, which could add a lift to inflation. But the market, as you can see on your screen, clearly not reading this as a Goldilocks print, instead reading it as a very hawkish one.
Yeah, we're keeping close tabs on some of the reaction in the futures here as well as in yields here. Maddie, Ali, thanks so much for breaking down the sectors and, of course, the ultimate reports that we can draw some through lines for as well. Thanks. Continuing our coverage of the December payrolls report, yields right now, they are moving higher. And we're joined by Blake Gwynn, who is the RBC Capital Markets head of U.S. rate strategy. You say that the possibility of a January cut is dead. DOA, when do you see the next Fed's policy move here going forward?
Well, I mean, to be fair, that January cut was already nearly dead before this print. Now we're probably looking at that March print. I think there's been an assumption in the market that basically since that hawkish December FOMC, we've largely priced out January, and I think market participants have been kind of thinking about this quarterly pace. So the Fed kind of skipping January, coming back in March, and just basically slowing down to every other meeting instead of every meeting. I think this really challenges that. When I look at March, the last 2 years, we've seen very strong seasonality in the Q1 data. It's come in very, very hot. If you look 2 years back, it led Powell to start talking about the potential for 50 basis point hikes again. Last year, the Q1 seasonality saw us price out about 150 basis points of rate cuts from December, to April. If we get a repeat of that, I find it very hard to think that the Fed's going to be able to come back in 2 months. Sitting on potentially 2 more months of hot data and deliver another cut. So I think they're done here.
Blake, we have the bond market reaction here to this print on the screen right now, and that's really what's driving a lot of today's action, a lot of the commentary and focus here on the street, because you got the 10-year just shy of that 4.8 level. You got the 30-year hitting that 5% level for the first time since November of 2023. What does that tell you?
I think it's actually the most interesting thing to me is the front end move today. And I say that because I think there was probably a good case for NFP where, it was just a little bit above consensus, where we saw a continuation of some of the price action we've seen over the last few weeks, which is that the front end yields remain kind of pegged. The market seems kind of unwilling to price out, more cuts. We've been kind of pegged at, let's call it the effective Fed funds rate, 2-year can't really move above that unless the market really starts to consider the possibility that the Fed could hike sometime in the near future. So we've been kind of pegged at the front end, meaning that all the good data, all the hawkish Fed, any kind of sell-off is really hitting the back end more. And so we've seen that bear steepening. So I think there was a case today where NFP was just okay. The front end remains kind of pegged and most of the sell-off was in the back end. This was so good that I think now we're actually seeing that front end, experience more of the moves. So that's actually surprising to me. If you would have told me there was a beat today, I would have expected more of that bear steepening where the back end is selling off more. And instead, we're actually challenging that front end ceiling a bit.
Interesting. What side of the duration are you comfortable holding long term right now?
If you would have asked me about 20 minutes ago, I was feeling pretty confident in holding some long duration. I mean, I think some of the sell-off we've seen to start this year is probably a bit overdone. The narrative has been kind of that, this is a big, this is concerns about deficit. This is inflation and growth running away from the Fed. I don't really buy those. If you look across some of the other data series or instruments where you would have expected to see those impacts, you're not really seeing it. I think it was really, just kind of a slow start to the year. We had a lot of supply. I think yields were kind of moving higher on a bit of a buyer strike, to be honest. A lot of the potential dip buyers that would have moved against the sell-off were probably sitting on their hands. I think the stabilization we saw yesterday, and the fact that we just have a pretty constructive environment for duration more generally, I think it's kind of challenged by this data today. And I think you need that stabilization. Nobody really wants to catch the falling knife. If yesterday would have continued and we saw that stabilization, I would have expected more dip buyers to come in and probably would have been tactically a little bit more long duration here. But this just extends that sell-off, I think.
Blake, are you expecting some of this continued volatility here for the months to come, just given the uncertainty, given the change in the White House and so many variables here at play?
I've been telling, particularly some of the, the analysts, the associates on the desk who weren't around for the last Trump administration. It's just a very different mode of operating than it has been the last 4 years. Look at the last week. We started off with a headline that was suggesting the tariffs were going to be, much lighter than expected. Trump came out a few hours later, categorically denied that. And then what was it, yesterday or the day before? There's an article that, they may do this emergency declaration to put in broad tariffs. So even just in a 4-day period, we've kind of whipsawed around on this tariff story. And so I think we just need to get used to the fact that we're going to get these headline bombs. We're going to get, not tweets anymore, but true social messages or whatever they are. We just have to keep our head on a swivel that we can get major shifts in kind of policy expectations, particularly around tariffs, which are the biggest X factor this year and have a very big potential to change the trajectory of the economic outlook and market outlook for the rest of the year. That can change on a dime. So we just, we're going to be pretty volatile, and I think we just have to keep our head on a swivel.
Yeah, I mean, look, I'm still recovering from the whiplash of Trump 1.0, so 2.0, more head on a swivel. That sounds like I'm going to be doing a lot more neck exercises. Blake, as you think about what has really come about in many of the calls for this year and this theme of American exceptionalism, how does that play through to the bond market, and how are you kind of looking through some of the other alternatives perhaps around the world where there could be a bit more stability if that's where investors are leaning into and looking for stability?
Well, this kind of goes back to the point I made just a second ago about the environment for duration being a bit more constructive from here. It's not just, a part of that is the cross-border aspect of it and the fact that, the outlook in the U.S. looks very, very strong. We have a Fed that, as I just mentioned, I think is done with the cutting cycle versus other regions where central banks are still continuing to cut. But if you look at, just some of the dynamics around owning treasuries here, we finally kind of have an income vehicle again. I think for a number of years, treasuries have been traded, from a prop perspective. You want that price to go up or down. You're hoping for capital gains. Really, more traditionally, it's a risk-free income vehicle, and from that perspective, yields look relatively attractive. Carry and roll down for owning, say, 10 years is positive for the first time in a long time. If you look at things, and this is to your point, on a cross-currency hedge-adjusted basis, treasuries look relatively a lot more attractive for foreign investors over the last month or so. So I think it's a constructive environment for owning U.S. duration, particularly against some other regions. And I think some of the big calls in our year ahead, were really kind of us versus Canadian yields, et cetera, rather than kind of outright in the U.S.
All right, Blake Gwynn, we have to leave it there. Thanks so much for hopping on with us and breaking this all down. Before we head to break, let's do a quick check on the markets. Again, we're looking at a leg lower here for futures. All three of the major averages on track to open the trading day in negative territory. Flipping over to the bond market, yields pushing to the upside once again. You got the 30-year yield touching that 5% level briefly. You've got the 10-year yield just below that 4.8 level. Flipping over to the dollar as well as we take a look at the reaction here. You look at the dollar index moving to the upside. We'll be right back. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you guys to 3 things that you need to know today.
Good morning, everyone. First up, a blowout jobs reports. The U.S. economy adding 256,000 jobs in December, well above estimates, sending stocks a little lower here as investors pare back bets on Fed rate cuts this year. The data playing out in the bond market with the yield on the 10-year spiking off of the strong results.
Plus, earnings season kicking off with reports from Delta and Walgreens. Delta shares moving to the upside after the company topped Wall Street's profit expectations, driven by gains in international and corporate travel. Walgreens jumping after sales at its pharmacies topped expectations. Higher prices for branded drugs and prescription volumes helped drive revenue to $39 billion for the quarter.
And TikTok heads to the Supreme Court. The future of the social media platform rides on a Supreme Court clash that pits national security against free speech. The justices will hear arguments this morning, just 9 days before a federal law is set to ban the app in the U.S. if it is not sold by its Chinese parent company. Unless the Supreme Court strikes down or otherwise delays the effective date of the law, the social site will shut down on January 19th. A blowout jobs report for December, surging past estimates, playing out in the market today as investors reposition for less rate cuts in 2025. As we're taking a look at the major averages, you're seeing declines across the board for the U.S. futures here as we're taking a look at the Dow, down 0.8%, the S&P 500 down roughly 1%, and the Nasdaq futures, you're seeing that lower by about 1.1% as of right now. But make no mistake about it, this was a very solid jobs report on pretty much every front here as we were taking a look at the beat on both the headline number and then additionally unemployment rate coming in a tick better than expected, 4.1% versus that 4.2% that many economists out there and those surveyed were looking for. Plus average hourly earnings, perhaps that was really the only one weak spot. That still rose though by about 3.9% year over year versus the 4% that was estimated.
Yeah, Brad, when you take a look at this print, it really just reaffirms the economy is on strong footing, at least when you take a look at the jobs market. Obviously, this blowout number here surpassing expectations. You've also got the unemployment rate ticking down by 0.1% to that 4.1% level. When you dig underneath the hood and taking a look at where exactly those jobs were at, we're seeing some strength. Not necessarily across the board, but in very many aspects here of this. You've got government adding jobs, just about 33,000, healthcare adding 46,000, leisure and hospitality hiring 43,000 here. The private sector payrolls added, that was another strong point. Maddie was breaking that down for us just last hour. So again, this brings up the question as to ultimately what this means for the Fed. Lots of talk about the fact that a Fed cut in January is obviously even further off the table, if it was even still on the table. At this point, looking ahead to March, lots of questions about whether or not that's even in play in the first half of the years. We have traders starting to price out exactly when we will see that first cut here coming from the Fed. Let's turn our focus to the Fed because our next guest is saying that the Fed's narrative will shift from quote unquote progress on inflation to risk management for growth. We want to bring in Ben Mandel. He's at Geopolitical Capital's head of research. Ben, it's great to have you here. So as you take a look at this very strong labor print, we've got traders right now shifting the full pricing here of the next Fed rate cut all the way out until October. What's your big takeaway?
I think the big takeaway is that it's extremely important to contextualize these data points in the broader context of the U.S. business cycle and what that's telling us about risks to growth and inflation. And the predominant factor here in this cycle is the avoidance of recession. And so there's an exceptionalism in the soft landing in itself. It's unusual in historical context, and it also creates a dynamic for growth and inflation that's highly atypical. So over the last 2 years, we've seen both growth and inflation decelerate, but decelerate very slowly, which is it's a strange phenomenon at the end of the cycle. And so what does that mean? The upshot for the economy and markets is that the short-run momentum in growth and inflation is really driving it's driving everything. And we saw that over the course of the last year. Q1 of 2024, momentum rose, and the Fed cuts came out of the outlook. Markets reacted, and then mid-year momentum waned. It went down, all in the context of growth, which is chugging along at a steady pace. And so it's really short-run momentum, which is really the key determinant here. And you can see that today's jobs report is indicative of high momentum in growth. I would kind of take the opposite side of the argument and say, we've kind of reached a peak, a local peak in both growth and inflation. We're kind of where we were in March, April of last year when everyone was extrapolating out, the Fed is done, they might start hiking. We've reached those levels of pricing. And I think the next step, to be honest, it just is a natural oscillation back downward over the next few months or quarters in both growth and inflation. And as such, as you said, the narrative is going to shift. It's going to be less concern about inflation, more concern about mitigating risk associated with growth.
What happens during a natural oscillation that you're talking about here? Because that would signal, at least for a Fed that's so data dependent and not seeing data that's strong enough to go one direction or another, that they could just be sitting on their hands for a while, but also the market anticipating that they could take other balance sheet measures, that there still would be the tone that would rattle through investors' mindsets and trying to figure out, okay, even if they are pushing out a move, then in the near term, what moves should investors be making as well?
Yeah, I mean, I think part and parcel of short-term momentum being very important is that monetary policy is going to absorb some of that volatility in the short-run data. And so I think what we've seen in terms of Fed pricing going from, over the course of the last 12 months, one rate cut or 6 rate cuts to 1 rate cut, back to 3, now back to 1, I guess, or fewer, is indicative of the Fed being data dependent and by construction absorbing some of the volatility in the underlying data series. I think the key thing to note is that we have to accompany the momentum in the short run data flow, which despite today's jobs report is not unambiguously strong. So that's one thing. And then as we consider the massive changes in policy that are in train and the raft of new policies, we have to think, well, are these more likely to affect growth or inflation? And I think the answer is almost unambiguously, and this is not a consensus view by any means, but it's almost unambiguously growth. So as we think about the extensions of the tax cuts put in place in 2017, most of those have to do with extending existing individual tax cuts, not introducing new tax cuts into the system. And so it's about maintaining the status quo, not necessarily adding new stimulus. If we think about tariffs and immigration, and I think there's a wide range of views on this, but I think the negative effects of growth of those policies will outweigh the positive or upside risks to inflation. Those are growth shocks, not inflation shocks. And so at the end of the day, I think when going back to your question about how do policymakers see these things, they'll obviously wait to see how the data play out. There's a natural volatility associated with Fed pricing as a result. But at the end of the day, we're wagering that it's mostly growth shocks and fewer inflation shocks, and therefore your directional view on treasuries is going to depend on whether you think growth momentum is rising or falling. I think we're comfortable owning durations at these levels in view of the fact that we think the dynamic in growth momentum is going to turn.
But what does all this then mean for investors? They're trying to figure out exactly what the gains could potentially look like this year if we don't get any more rate cuts, or if rate cuts are essentially pushed out to at least the second half of the year. Is that going to maybe take off some of this momentum that we have seen from the recent rally?
That's a good question. I think momentum is certainly important. I would say the thing where maybe investors have where they've erred is in putting a little bit too much weight on valuation as a signal. And so, when we think about, I think the key example of that is the U.S. versus the rest of the world. You could have argued any time pretty much over the last 10 or 15 years that the S&P is expensive. Part of that is probably coming from the fact that we have very little, perhaps we're underestimating the importance of the S&P containing important global firms in important global industries. And as a result, perhaps maybe underestimating the fair value multiples associated with those, and then overestimating how expensive the U.S. index was relative to everyone else. And so, I think momentum is important. I would say valuation is probably less important than investors have been wagering over the last few years.
Interesting. Ben, thanks so much for taking the time here with us after the December jobs report and ahead of the opening bell this morning. Appreciate it.
Thank you very much.
Certainly. Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. All right, first up, there you see it on the screen. Taiwan Semiconductor, their revenue for December beating estimates, up more than 57% from December of last year, boosted by some continued AI demand. The chip maker also posting its highest annual revenue since going public in 1994. Where were you when? Take a look at shares. They're up by about 0.7% as we're taking a look at some of the results here from this December revenue report. They also did note that on a consolidated basis for the month of December 2024, they saw an increase of 0.8% sequentially from November 2024. And then, of course, that increase that we saw year over year and mentioned a moment ago of 57.8% from December of 2023 here as well.
Yeah, and I think, Brad, the big takeaway here is from these strong numbers. Obviously, the reason why this is so important is because it's a go-to chip maker for names like NVIDIA and Apple. When you see a 39% rise in revenue like we did, that's obviously a bullish sign here for the industry moving forward. And I also think this reaffirms maybe some of those expectations or further bolsters some of those expectations that these larger cap tech names, when you take a look at names like Alphabet and Microsoft, are going to continue to spend and build and upgrade their data centers in order to better position their businesses for this AI boom and what that demand is going to look like here in the years to come. So again, TSMC's sales here beating expectations, boosting their AI outlook here for 2025. Obviously, we're seeing that reflected on the street here. Some optimism playing out as well. We'll see whether or not that holds just in terms of when we do get more of these numbers from some of the names that are up on your screen right now, whether or not that is consistent here with what we're hearing from TSMC this morning.
I think some of the strength, too, is really pointing back to the fact that you're not going to see, at least in mass, some fabrication platform or plant that comes online at such a rapid clip that it clips TSMC's ability to continue to hold on to its existing client base, the demand that they're seeing for being able to fabricate and their own wafer processes for these chips here. And until you see that come forward, we're still going to be watching TSMC be one of the de factos until more Hanhai or Foxconn or till more Intels of the world are able to really not just break ground, but also begin producing chips at the same type of level that TSMC is doing as well.
All right, let's take a look at NVIDIA. NVIDIA criticizing new chip export restrictions put in place by the Biden administration, potentially saying that the White House is preempting incoming President Trump by, quote, enacting a policy that will only harm the U.S. economy, set America back, and play into the hands of U.S. adversaries. The additional round of restrictions originally reported by Bloomberg this week, saying that it would cap the sale of U.S. AI chips on a country and a company basis. We're looking at the stock under a bit of pressure here this morning, off just about 2%. Ned Finkel, he is NVIDIA's Vice President of Government Affairs, saying in a statement that the extreme country cap policy will affect mainstream computers in countries around the world, doing nothing to promote national security, but rather pushing the world to alternative technologies. And NVIDIA very much a leading seller of those so-called AI accelerators, the data center operators use here to develop AI models. So again, this restrictions obviously could potentially have a direct impact on their business, and they're being very vocal, to no surprise, about their opposition to this.
Yeah, this is not just NVIDIA that's been pushing back against this. You have a lot of organizations, Information Technology and Innovation Foundation out earlier this week. They had their own reaction to this, saying that the rule would impose country-specific caps, along with a license regime on U.S. exports of semiconductors, most notably impact GPU chips that underpin key AI applications, such as the development of large language models. And in all of these reactions that we're seeing, either from companies or from focus groups or from foundations, they're all kind of continuing to note, yeah, this is all happening as the Biden administration draws to a close and has had a series of final acts, closing acts, if you will. But this has largely been regarded as one of the over-designed yet uninformed one, at least from this particular organization here. And no doubt we'll probably hear more from some of the other companies. NVIDIA probably stands to lose the most as a result of this, considering the market share that they've built up to this point, too.
All right, well, coming up next on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, acting Labor Secretary Julie Su reacting to the December jobs print. On the other side of the break, we've got that and much more coming up next on Yahoo Finance.
Welcome back to Yahoo Finance, live from the Labor Department here in a chilly nation's capital. I'm Jennifer Schonberger. That jobs report coming in much stronger than expected this morning. And for more insight on that, I want to welcome to the program outgoing Acting Labor Secretary Julie Su. Secretary Su, always great to see you.
For me too.
Strong jobs report this morning across the board. Payrolls, the unemployment rate dropping to 4.1%. Yet, more than 1.6 million Americans have been looking for work for at least 6 months. That number up 50% since 2022. So how do you juxtapose what we're seeing, what appears to be strength on the surface, but then people, especially in white-collar jobs, having difficulty or a long time before they can find new positions?
Yeah, I mean, I think so. The first part of your question, right? Exactly right. These numbers demonstrate continued, really steady, stable job growth. This is the only president that has had positive job growth every single month of his presidency. And that doesn't happen by accident, especially when you look at where we were in 2021. And so we now have a total of 16.7 million jobs created under this administration, broad-based, right, across many, many industries. The one statistic you're talking about is that it is taking people longer to find jobs. But when you look at labor force participation, participation, people aren't giving up. That means there are jobs to be had, and people are, they're staying in the labor market to find them, and because real wages are also up, once they get them, they have a little bit more breathing room when they go to work. And so these are all very much fundamental to the way we envisioned what a strong economy centered on workers should look like.
Why do you think it is taking so long for many of these people, especially in white-collar jobs, to find those positions?
We don't have data about that specifically, but I will say that some of it is in an economy in which workers have been doing well. I mean, tight labor market, right? More jobs, higher wages. Workers have had more choices, and so sometimes people have held out for better jobs that better connect with their desires, their interests, what they want to do. And so there could be lots of reasons for that, but the overall picture of the economy remains one in which people come into labor market exceeding the pre-pandemic labor force participation, right? So it's not just that people came back. It's not just that we've recovered. It's that we've built up to a stronger economy than we've ever seen that we're going to pass along to the next administration.
Speaking of the next administration, President-elect Donald Trump said in a press conference this week that, quote, he's inheriting a difficult situation from the outgoing administration and that inflation is continuing to rage and interest rates are still far too high. Just on my way to the Labor Department this morning, I was talking to my Uber driver and he was complaining bitterly about the cost of living, the cost of groceries. Your response?
So there's a lot to be said there. Let me unpack it a little bit. First, that sounds like a well-known pattern of someone who tries to lower expectations for what he will have to deliver and find someone else to blame. The numbers don't lie, right? And the numbers across this economy demonstrate real strength. And we've talked about this here before. I've traveled around the country to see working people walking into jobs that did not exist 4 years ago. But it is true that our work was not finished, and the need to continue on this path is going to require real leadership. The kind of vision where we can't just care about the number of jobs, though that's important. We have to care about the kinds of jobs. Right? We have to care that people can make a decent living. I mean, that driver you're talking about is part of a population of working people who often have to piece together a life because the job that they have doesn't pay them enough to survive. That's a real problem, and so we've focused on making sure that real wages are up, on supporting unionized workers, and on enforcing the law for those who need the Department of Labor to be strong so that they get a just day's pay. All of those are part of a bigger picture of work that remains.
We know that the president-elect has promised tariffs. We don't know to what extent we will see tariffs and that those will be implemented. But generally speaking, what's your sense of what impact that could have on the job market?
Look, he promised that he would bring down prices on day one, and now he said it's hard to do. He talked about tariffs, and by most accounts, the kinds of things that he's blustered about are not going to be good either for the economy or for prices. So it remains to be seen. I think what this administration has demonstrated, though, is that a strong economic recovery and continued economic growth is possible with the right investments in industry, with the right commitment to workers. Like, we cannot build an economy off the backs of working people without making sure that workers also do well. And through the work that we've done, we have now 400,000 workers in unions who were not in unions 4 years ago. We have millions of workers with union contracts that are going to last them 4 years or 6 years, and have lifted up wages in not just for them, but for their entire industries. And if the investments that we started continue, there will be continued job growth.
How are you working with the incoming administration and the potential next labor secretary? What is your advice?
Well, this president has also been clear from the beginning that we would have a peaceful transfer of power. And so my team has been working with the transition team to make sure that they have what they need. They've been on site here in the office. And we know that a strong Department of Labor is essential to America, to vulnerable workers who shouldn't have to come home with an injury, right, losing their limbs or their lungs or even their lives on the job. Nobody should have to do that. And we also know through our enforcement work, under this administration, fatalities are now at the lowest rate that they've been since 2017. Injuries on the job are down. It demonstrates that when you enforce the law and send a clear message to employers who might try to cut corners or try to catch a break by breaking the law, that's not going to happen. That really does make a difference.
The World Economic Forum is out with a brand new report this week on the future of jobs. They estimate that by the year 2030, while 170 million jobs will be created, 92 million are projected to be displaced by technology and AI. Is the U.S. prepared for the change in skill sets required by employers and this evolution? And how will that impact the job market?
So one important point about those kinds of predictions is that none of that is inevitable, right? None of that happens just through natural forces. There are choices that we made, policy choices, whether we ask the right questions, whether we put on the right guardrails, and whether we prioritize workers. I've never met a worker who said, I don't want something that can come to the workplace to help me do my job better or help keep me safer, right? But there is a way in which we can think about technology and ask the question, how can technology actually benefit workers? How can it make life better for working people? How can it make jobs, jobs safer, workers more secure? And so those choices are going to determine exactly what those outcomes are. And yes, we definitely we've demonstrated that over the last 4 years too. When you create good jobs and when you connect people to those opportunities, including people from communities who've been left out in the past when there was opportunity, that the American people want to work and they have the talent and the skill and the hunger to do so. And the Department of Labor's investments in workforce training programs are really key to that as well.
You said this week, looking back 4 years and to where we are now, that the unemployment insurance system isn't ready for the next economic crisis. Why is that, and what else needs to be done?
So COVID really revealed just how fragile that system was, right? If you recall, claims for unemployment spiked some 3,000% in a single week at the height of COVID. And the unemployment insurance system is supposed to be able to deliver benefits to people in times of crisis. And what we found was that system, due to decades of underinvestment, was just not up for that challenge. And so what happened was, it had to be, basically, I've likened it to, you're having to repair a leaky roof in the middle of a storm. You just can't do that. So now that the economy has been strong, we've committed to that task of repairing it, of making sure that it works in the next crisis. But again, decades of disinvestment and underinvestment don't get reversed overnight. But we've made significant progress in partnership with states to do everything from modernized technology to enhance fraud detection methods to provide a federal partner to the states to do this work. And so that's also work that we're proud of having accomplished, but the work is not finished, and it needs additional monetary investments, but it also needs the additional work and the additional partnership and focus of the Department of Labor to make sure that when the next crisis hits, it's ready.
Secretary, so I want to thank you so much for your insight today and for all of your insight over these past years as acting labor secretary here in the Biden administration. We've so appreciated it.
Thank you so much, Jennifer. Thank you.
And best of luck to you and your family. I know you're from LA with all the wildfires.
Thank you.
Thanks so much. That's acting labor secretary Julie Su. We'll be right back after this. You're watching Yahoo Finance.
That's a live look at the opening bell at the New York Stock Exchange, where you're hearing the bell ring. God's love we deliver. They're up on the podium. And at the Nasdaq, you've got Wellness Week rolling on, and you've got some esteemed bell ringers kicking off today's trading activity over there. Anteris Technologies is the name of the group. They get some funfetti. All right, let's take a look at how things open up here on this Jobs Friday. We're seeing some early declines here at the opening across the Dow Jones Industrial Average. Starts the day off lower fractionally by about 0.5%. The S&P 500, you're also seeing that start off the day down by about 0.7%. And as the Nasdaq Composite calibrates here, we're taking a look at declines right now of about 0.9% here. We're also taking a brief look at the 11 S&P 500 sectors here. Out of the gate here this morning, you've got a lot of red. Real estate is the worst of the decliners right now. It's down by about 1.7%. Energy, though, to the other side of that, is up by about 1.7%. Utilities also catching a bit of a bid here. And then just briefly, I'll take a look at the Dow 30 components here as we're just taking a look at what looks like more decliners than gainers right now. Chevron leading the pack, NVIDIA pulling up the caboose. Jared, I'll toss things on over to you for a deeper dive.
Thank you. We got a lot to cover here. First of all, small caps are leading down. Let me just pull up the Russell 2000 real quick. I'll give you the year to date. You can see still maintaining gains for the year, but we have a pretty negative reaction to this jobs report. And by the way, we're actually seeing the Nasdaq down 1% right now. I'll give you the intraday real quick. I want to go to the bond market because what's happening to the 30-year is pretty surprising. We have it touching 5%, and that is the first time it's touched 5% in over a year. Here's the 3-year look. Now, it's not the absolute high on this chart, but we talk about the dollar wrecking ball and higher treasury yields pressuring stocks. That is what is in store right now. So sometimes we see a reversal off of these payroll reports. Maybe that's what we get today. But that 5% on the 30-year, that is a warning shot. Looking at the sectors here, energy is the only one majorly in the green. That's up 1.5%. Utilities up 1/3%. Real estate down 1 2/3%. But we're seeing some negative action in the majors. NVIDIA down 2.64%. That is the worst off of all of the Mag 7 stocks. And I'm going to leave you on crypto because Bitcoin had a little bit of a negative reaction here, but it is holding support. We got that 90 to 93, 94,000 support level in play here. So at least Bitcoin looking positive this morning, guys.
All right, Jared, thanks. So now for today's strategy session, a blowout jobs report showing the resilience of the U.S. economy, but weighing on investor sentiment, at least for now. So how should investors be digesting a robust economy with slowing earnings growth? We want to bring in our very own Miles Udlin here, head of Yahoo Finance News. Miles, how do you think investors and the street are looking? Obviously, they're not too excited, just judging by at least immediate reaction.
Well, I think the reminder, especially as we head into Trump's inauguration, where he really is all news runs through what the incoming president says about literally anything. What investors have been focused on and are clearly remaining focused on is the rates picture. And when you see a jobs report like this, you are again, and you saw it in the futures, in Fed futures this morning, we now are looking for one rate cut in 2025, none until June, and 6 months is a long time for investors to wait to get additional clarity on how the Fed might be thinking about their positioning. We saw, Michelle Bowman come out last night and say, I think we're all set here. I would have supported no cut in December. So the picture for investors who I think we're looking to get excited about something other than big tech, where you are going to still have earnings growth kind of, at this point, the logic is regardless of the cycle. But, that S&P 493, the whole point there was, all right, we're finally going to get some relief on the rates front. If the economy is fine, but we have a little bit less pressure on our cost of capital, then we can start to look at those earnings. You can, put a turn of leverage on there and get, more interested in some of those stories. But, Sam Rowe, our old managing editor, was tweeting out this morning, this is the exact same setup that we saw in January of 2024. And I think investors were just looking for something different in 2025. But it really just feels like Groundhog Day for investors, where you have the economy overperforming, rate cut expectations coming down, and as a result, the balance of the market under some pressure, and you're looking at the same old thing. You're looking at crypto, you're looking at big tech, and I know that that's done well if you buy the S&P 500, but professional money managers don't get paid to buy the index. So they are trying to find other areas of opportunity. They haven't really appeared yet, and this jobs report makes that more challenging.
Which the core difference here between beginning of 2024 and beginning of 2025, to the point of where you started, is that we're going to have somebody different at 1600 Pennsylvania Ave or Mar-a-Lago. But the other thing here that we're anticipating, at least from FactSet, is this calendar year earnings growth of 15%. Do you think we're going to need to see some revisions to the downside on that?
Well, earnings growth is almost always revised down throughout the year. Of course, the impressive story in 23 is that it wasn't. In 24, it was revised down less than expected. So perhaps you do see that again in 25. What's interesting for investors is we're in January of 25. Really quickly, we're going to start talking about 27 and 28 estimates, because that's real. Because ultimately, what we're saying is, can you compound at 6%, 8%, 10% kind of earnings growth? That headline 15% number is obviously greatly impacted when you have the largest company, in the market growing profits. Last year we were up hundreds of percents, depending on the quarter you looked at for Nvidia. So when you have that kind of skew, that headline number looks really good. But ultimately, under the surface, the question is, can you have a large swath of companies that are growing at GDP plus, and does this whole picture, what's happening with tariffs, what's happening with inflation, what's happening with rates, does that kind of support that for investors? And given how top heavy the market has become, I think the answer right now is that remains mixed, but it continues to be, Jared talks about it almost every day. It's an under the surface churn story. Whereas we can look at the headline indexes and say, I guess this seems fine. But there are plenty of ugly pictures, plenty of ugly charts out there, depending on where you want to look.
Right, and on the 3 to 5 year point, that's exactly what we saw with Delta as well, which I know we're going to get to in a hot second, so I don't want to front run that too much.
I was wondering if you'd bring it in.
I had
Came
to.
early.
Why not?
Didn't disappoint. All right, Miles, come back soon, will you?
Oh, I'm out. That's it. Great. Good to see you guys.
All right, let's turn now to the latest in Southern California. In Southern California, 5 wildfires are still burning. They have spread to nearly 30,000 acres, damaging or destroying over 10,000 homes and businesses. 180,000 people are under evacuation orders, and so far, 10 people have died. The LA wildfires are on track to being one of the costliest natural disasters on record. Current estimates from AccuWeather seeing the losses between $135 billion and $150 billion. This will likely add stress to the already fragile insurance market in California. Last year, 70% of State Farm customers in Pacific Palisades lost coverage. Private insurers like State Farm, Allstate, and Farmers Insurance have stopped selling new property and casualty coverage in California, saying that the cost to underwrite policies is too high given the number of natural disasters in recent years. Joining us now for more, we want to bring in Kathy Seifert. She's the Vice President of CFRA Research. Kathy, it's good to see you. When you take a look at what is happening, the tragedy of the loss right now in California, the fact that the wildfires are still burning, talk to us just through how you're assessing the economic damage and ultimately what that spells out here for the insurance industry.
Sure. There's a lot to unpack here, but let's first talk about the initial assessment. And right now, as of this morning, the largest fire is only 6% contained. So I think loss estimates, insured loss estimates, and I think it's also important to differentiate between total economic losses, which will be in excess of $100 billion, versus insured losses. And there are insured loss estimates, which basically means how much insurance companies are going to be paying out. The ranges now look to be, 20 to 30%. I think ultimately it's going to be higher than that. And so, we have obviously this big catastrophe that was honestly, I don't want to say, obviously it's shocking and a surprise, but a lot of people in the industry were not overly surprised by this. We have that issue. The insurance industry does have the capacity to address these claims. The issue, though, is a crisis of availability for homeowners in California, and there are a lot of issues driving that.
And so, Kathy, how does this change, to the second part of Shauna's question, the future of insurability in certain regions that are more prone to disasters like this?
Well, climate change, which we have an incoming administration that doesn't want to address, is going to increase or decrease the availability of an insurance, increase the crisis of availability, the protection gap, and ultimately the costs of climate change are inflationary. As it relates to the California insurance market, interestingly enough, there has been an issue in California because California regulators mandated that companies use a retrospective rating process, which means they had to look back historically at claim trends when they were setting rates. A lot of other states allow insurers to look prospectively and to model the likelihood of claim cost inflation when setting rates. Starting this January, California finally adopted a prospective rate setting methodology. The combination of that, plus the fact that very few carriers want to do business in California, means that homeowners in California are facing massive increases in their homeowners insurance coverage.
And Kathy, for our audience, just from an investor perspective, the insurance stocks, what insurance stocks have the most exposure or at most risk here of what is playing out in California?
So State Farm is the largest homeowners insurer in California, and that's a mutual company. A lot of the publicly traded insurers over the last decade or so have reduced their exposure. Within the publicly traded space, Allstate has exposure, Chubb has exposure, Travelers has exposure, and Cincinnati Financial, a regional carrier, has exposure. My sense is that it will be manageable. And I would also point out that last year we had an elevated level of catastrophe losses, 140 insured catastrophe losses in the U.S. Property casualty insurance stocks were among the better performing financial sector names last year, largely because these level of claim costs give the industry pricing power. It's a little counterintuitive, and my sense is today the group is going to be down as people assess the level of claims and the implications. And then once people get a better sense of how much this is going to cost, they'll, assess that and then move forward with the likelihood that this will be another pricing catalyst for the industry.
Kathy, thanks so much for taking the time here with us, helping us to the best ability break down some of the devastating story that continues to unfold in front of our eyes. We appreciate it.
My pleasure.
We've got much more ahead on Yahoo Finance. Stay tuned. Delta Airlines reported earnings this morning before the bell. Stock moving to the upside today by 10% on the back of those earnings. Here are the three biggest takeaways from the latest results here in my conversation with the Delta CEO, Ed Bastian. One, over half of the company's fourth quarter sales, they came from outside of the main cabin, a focus on premium. CEO Ed Bastian told me that the company is seeing strong interest in, get this, its business and international segments. Listen in.
Seeing growth in the corporate space, double-digit growth in corporate bookings. We're seeing the international area, all the international areas of the globe showing very, very healthy growth going into the new year.
He also said that the number one issue facing Delta right now is congestion, and he wants to see the FAA modernize its technology and incoming President Trump, continue investment in the air traffic control system. And third here, the company is making new plays for the premium consumer, from brand partnerships with Uber, DraftKings, and YouTube, among others, to bring a more holistic premium experience. It seems like some of those miles that you aggregate on the ground could benefit you in the skies as well, Shauna, in the near future. He was at the Sphere in Las Vegas at CES. So a little remarkable to see some of these announcements and really peg to the premium consumer, Shauna.
Wish he took us with him there.
I wish.
Where to go?
Lenny Kravitz was there.
I know. I heard it looked like a lot of fun. Maybe there's always next year, hopefully. All right, for more on Delta's performance in the airline sector, we want to bring in Stephen Tren. He's Citi's managing director. Stephen, it's great to have you here on site. You just heard Brad break down what exactly we heard from Delta's conversation with Ed Bastian yesterday. What was your biggest takeaway from the quarter?
Yeah, absolutely. Good morning, and thank you very much for having me. So I think that what he said about premium is very important. And I think network airlines relative to discount carriers, that cabin segmentation has been underappreciated by elements of the market. So not everybody wants first class, but not everybody wants basic economy. There's an ecosystem in between, and that's allowing the network airlines, Delta, American, United, for example, to maximize that opportunity in a way that discount carriers are not going to be able to do.
You know, I wonder, Stephen, because you look across these airlines and you have a good sense of where they're expecting to take delivery of aircraft this year. In my conversation with Ed, it seemed like they're looking for about 40 aircraft this year and then still waiting towards the end of this year, early next year, for that Airbus A350-1000, the new kind of premium or flagship experience in the sky that they're talking about. Who is best positioned among the airlines right now to really outpace and then add more capacity to their system because of their aircraft delivery this year?
Yeah, so the largest carriers tend to have the biggest punch in terms of when the large OEMs want to make deliveries and who has the priority in the skyline. You know, and as I think we go through the next couple of years, there's probably going to continue to be a paucity of capacity, especially new capacity per capita, especially large cabin. You know, so we think about these lucrative corridors like the transatlantic, and this equipment coming in late this year, early next year. You know, I'm going to go back again and be a broken record. It's going to be a Delta, United, American Airlines. Those kind of carriers look positioned to benefit.
You also have three key themes for airlines that you're watching in 2025 here, and we've got them on the screen here for our viewers. Airline revenues outpacing low-cost carriers' results, inflation and interest rates staying high, and then oil prices. Why are these your three key themes and areas that you're focusing in on for airlines this year?
Yeah, maybe I'll start with the third one first. Oil prices definitely continue to move these stocks, and the market should be focused on them. But when we think about long-term inflation, there's been plenty of ex-fuel seat mile cost inflation across the group. But if you look at jet fuel kerosene on a long-term basis, you know, go back to 2008's high, for instance, we're now well below those levels, if you consider what's happened in real terms. So oil and jet fuel kerosene more directly is still important, but as a percentage of revenue, it's been on its way down. I think the other two things, you know, have been a focus in terms of inflation and interest rates, because I think today it's been easier to travel for folks that are better economically off, and it's been a little tougher for those folks and more modest socioeconomic strata. So there's been some expectation you'd see a pickup in that group as rates come down, but maybe they're not going to come down so much. So that's a little bit tougher for the discount airlines.
Interesting. Steve, we got to go. One word answer here. Top pick airlines for 2025.
American Airlines is on our focus list.
All right. Steve, thanks so much. Appreciate it.
Thank you.
Good to see you.
Same here.
Sean, I'll toss it over to you.
Brad, Walgreens out with earnings before the bell this morning. It comes after a difficult year for the company. So we want to put this in perspective here, and then we'll break down today's report. The stock selling off last year. It was the worst performing stock in the S&P 500. You can see, though, shares, at least this morning, are moving to the upside. But we're talking about the performance of the past year. And you can see that steady decline here to the downside in 2024. So let's take a look at what has played out at Walgreens over the last 18 months. Starting back in 2023, Rosalind Brewer abruptly stepping down as CEO. That came after less than 3 years in the role. The move following the company's stock after it fell by nearly half. And a strategy to broaden its reach as a healthcare provider certainly did stumble. Brewer's efforts to shift Walgreens' focus from its core pharmacy business to operating doctors' offices and providing other services weighed on shares. Tim Wentworth then took over as CEO in late October 2023 and quickly laid out a turnaround strategy. In January of 2024, so the beginning of last year, just about a year ago, the company laying off 10% of its corporate staff. Fast forward to October of 2024, Walgreens then released plans to close about 1,200 unprofitable stores in the U.S., but shares still under pressure. That came as a report that we got back in December that Walgreens was in talks to sell itself to private equity firm Sycamore Partners. Walgreens market cap down from a peak of about $100 billion in 2015, just about $7.9 billion today. So we've certainly seen a dramatic fall. And again, it was the worst performing stock in the S&P 500 of last year, Brad.
All right, Shauna, thanks so much. We've been tracking shares of Walgreens as well, popping double digits after its earnings beat. Ahead of these results, Yahoo Finance reporter Anjali Khemlani flagged 3 key areas to watch: prescription volume, store closures, and Village MD performance. Anjali joins us on set right now. What did we find out in these results?
Yeah, so top line, just looking at the results, of course, beating the consensus on adjusted earnings per share, as well as beating on sales and revenue. So $39.5 billion compared to consensus of 37. So that's really good on the numbers. And that's despite the store closures. That's despite a lower than anticipated winter season. So the cough and cold season, usually good for vaccines, usually good for, all the over-the-counter medicine. That's been slower, even though it feels like we've been in the middle of an active year. But those are the numbers that came down. We also know that CEO Tim Wentworth was talking a lot about, the store closures, the impact they're having, and seemed pretty positive and basically asking the street for more patience as he tries to implement a new strategy to help turn around those front of sale stores, the front of store sales, which has always been a drag and continues to be a problem for retail health. He did notice on the vaccines, though, at least kind of a bright spot, saying on the call that while the vaccine volumes haven't been quite as strong, at least the reimbursement was pretty fair for those vaccines. And so that tells us something to look ahead for earnings coming up this season, that we might hear lower numbers than expected for those vaccine sales for those manufacturers. So just something to keep an eye out for in the future.
Anjali, thanks so much for tracking all things Walgreens this morning. Everyone, we've got all your markets action ahead. Stay tuned. You're watching the Morning Brief. In just minutes, TikTok and those users will face off against the U.S. government in arguments before the Supreme Court. Here with what's at stake, we've had Yahoo Finance's Alexis Keenan all over this one. Alexis, what are the arguments that are being presented here?
Yeah, so what's going to happen at 10 a.m., so just in a few minutes here, the U.S. government, TikTok users, they're going to square off and they're going to argue over whether a law that was passed by Congress, signed into law in April by President Biden, requiring TikTok to either be divested by January 19th or be banned countrywide, whether that's constitutional. Does it violate the First Amendment's protection of free speech? TikTok and the users, they say yes, that they both are entitled to free speech protection. It will be a real test of whether Congress can prioritize national security over the editorial choices of a company that's owned by a foreign adversary and over the speech of Americans that make their speech on that platform owned by that foreign adversary. Now, the law is set to take effect, as I was saying, just in 9 days. The court could choose to uphold it. They could strike it down. They could put it on pause. We don't know what's going to happen, but there are going to be the attorneys in court today in just a few minutes making their separate claims. As for the DOJ, the DOJ says that as a foreign entity, TikTok is not entitled at all to constitutional protection under the First Amendment. They say that the law doesn't even target speech, so that's not a concern. They say it only restricts the foreign ownership of TikTok. They say there's no burden on speech because simply the company can be divested and the speech can continue after on an alternate platform. Guys?
All right, Alexis, thanks so much. Keep it right here on Yahoo Finance. That does it for Morning Brief. Coming up next is Catalysts. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get to the 3 catalysts that we're watching this hour.
First up, a blowout jobs report hitting stocks today as investors rethink their rate expectations. We'll break down how to trade the changing rate landscape as treasuries fall off.
Plus, we break down the biggest geopolitical risks facing investors and how to navigate Trump's tariffs plans this year.
And TikTok's future is in the hands of the Supreme Court, which is hearing arguments on a bipartisan law requiring a sale or ban of the Chinese-owned app. We'll speak with the investor and Shark Tank star Kevin O'Leary about his bid to buy the app. That's next, right here on Catalysts. Let's take a look at some market headlines to start the hour, sponsored by Tasty Trade. Taking a look at the major averages, still under pressure this morning following that better than expected jobs print by a mile from that jobs number coming in. Really hot here. You see the S&P 500 down nearly 0.9%, but a lot of the pain really in those tech-heavy large cap names. The Nasdaq down nearly 2% in the trade, and a lot of that is being driven by the action that we are seeing in the bond market. We've seen the 30-year in particular on the longer end of the curve continuing to push up, the 30-year hitting that key 5% level at one point this morning. You can see the 10-year up an additional 4 basis points at the moment. That bearish momentum in bonds potentially having more legs and momentum moving forward here, as throughout the week we have not seen buyers coming in, and that has given this move and bear steepening a little bit of more momentum here this week.
All right, well, the move today coming amid several bearish calls on the bond market, with ING forecasting the 10-year yield could rise to 5.5% by the end of the year. You've got T. Rowe out with a scenario and a call saying that there is a potential in the realm of possibilities that maybe we could even see 6% on the 10-year yield. So here to break that all down, where we're headed next, we want to bring in Leslie Falconio. She's the head of taxable fixed income strategy at UBS Global Wealth Management. Leslie, it's great to have you back here on Yahoo Finance. So we certainly are seeing a push even higher here in yields on the back of this morning's very strong jobs print. I think the next milestone that investors are closely watching is that 5% level for yields. Is that likely coming in the next couple of weeks?
Oh, you could absolutely see that 5%. I mean, that 501 was the October 2023 high. We're 25 basis points away from that. We have inflation numbers coming out next week, and still a lot of unknown in terms of policy. So seeing that 501 is definitely attainable, but we just don't believe it's sustained. And some of the reasons why we don't think it will be sustained is that when we look at what's happening, such as 10-year real yields at a 235, they're about 15 basis points below the high that we saw in October of 2.5. And at that point, I think in that over 5%, even if it is on like strong payroll like we saw today, we think risk assets, start to get a little bit nervous. So you could see 5%, you could see 5.10, but the question is whether or not it's sustainable. We just don't believe that it will be.
What level is sustainable?
Listen, we still think, we think growth is going to be trend down, but remain, above trend, right? So we still think growth is going to stay strong. Obviously, today's employment with, 256, it's the highest we've seen since March of 2024, and around the 48th consecutive positive number that we've seen. So the economy is strong, but we do think over time, growth will start to slow, but stay above trend. But we also believe that over time, inflation is going to come down as well, simply because our expectation is that things like owner equivalent rent will start to trend lower. So we have strength. We have, a strong economy. We just don't think you're going to, be at a 5 or 5.10, particularly since now the market is already pricing out most cuts. It's down to only one cut in 2025, later in the year in September. So the question of whether or not they're going to pause or not really isn't a question anymore. I mean, it'd be highly unlikely that they go in March, cut in March, unless you see some, true collapse in next week's inflation report or some sort of negative payroll the next couple months. So a lot of this bearishness, if you will, is priced in simply because they've taken out so many cuts.
Leslie, the market now only sees one cut here this year. Do you?
We see two, actually. We're still staying with the two. We have June and September, right? But listen, there's a lot of data from now to then. And one thing that we know, and the Fed has stated clearly, they're data dependent, right? So you're going to see a lot of shifting narrative for each number, which really just makes the interest rate market that much more volatile, and will probably continue to be volatile given there's such data dependence. So we have a rhetoric right now that the economy is very strong. They're not going to cut. 6 months from now, that narrative can completely change. So as of now, we're staying with the June and September 25 each, so 50 basis points in 2025. But again, it's really going to depend on what the data shows.
Talk to me about what you're anticipating as we look ahead to the next 4 years under the Trump administration. We know that Trump's Treasury has talked about shifting away from shorter-term borrowing. How do you anticipate that impacting the yield curve?
I think that's a great point because when you look at, supply, listen, supply is really more of a 2026 issue, right? I mean, it's not so much a 2025 issue, but to your point, what the market will be paying attention to in 2025 is the composition of that supply, meaning that, whether or not they choose to take those bills that have been used to fund the deficit and lock them up, right? So you extend out 5, you extend out to 10 years, and that composition change could have an impact on treasury yields. But I think that's one of the reasons why that we have this rising term premium, why the yield curve is steepening, because investors are looking for compensation for that potential. But, we really don't know, or really don't see a lot of supply, or is increase in supply a concern until that 2026 sort of time frame. But even listen, a lot is going to get to be seen in terms of what they could actually get passed through, particularly when it comes to further tax cuts outside of just the extension. But that's going to be, I think, an end of the year type of issue into 26. What's not is how that composition works and whether or not they take those bills that are rolling off and lock them in a little longer. But I think that you're getting compensated for that now, and that's why the term premium has been rising so much.
All right, Leslie, thanks so much for joining us.
Thank you.
We're going to move over to consumer sentiment data crossing the wire for January here, coming in below the estimate at 73.2. The estimate was 74. Really interesting to look at the inflation expectations. Year-ahead inflation expectations rising to 3.3% versus the estimate of 2.8%, so a huge move to the upside on that. And then the 5 to 10-year inflation expectations rising to 3.3%. That is the highest 5 to 10-year inflation expectation since 2008. So certainly key when we think about consumer expectations for inflation potentially as an indicator that that inflation story is coming back in.
Yeah, and I think that's really ultimately maybe why we did see an uptick here in that headline number, just in terms of what we did see versus the expectations. Again, the consumer sentiment coming in at 73.2. When you take a look at some of these headline numbers here, it was 74 the prior month, so maybe just a bit of improvement. But I think this still illustrates that inflation is very sticky, right? And that's one of the challenges that economists and investors are grappling with right now, trying to figure out just what exactly that trajectory looks like if we are going to see any improvement on that number here over the next several months to a year, and to the extent of that improvement. And I think that's why we have seen so many traders, so many investors just split, and economists split on what exactly the Fed is going to do next and the timing. We were just talking to Leslie Falconio, and she was saying how the market's still pricing in, or the market is now pricing in only maybe one cut this year. She's still pricing in 2 cuts this year. We had Blake Wynn from RBC earlier on in the program saying that he actually thinks the Fed could be done this year in terms of rate cuts. So again, I think that just plays into this debate that we've long been having here on Yahoo Finance and beyond on Wall Street, just in terms of what the Fed's policy path is going to look like going forward, considering the fact that inflation does remain so sticky.
And the growth that we saw in the labor market as well, a lot of growthy areas today. Well, escalating geopolitical tensions, a change inside the White House, and the Fed's uphill battle with sticky inflation are top of mind for investors as we kick off 2025. Amid the challenging environment, the Eurasia Group's top risks of 2025 is out. Topping that list is the risk that G0 wins, meaning a lack of concentrated power driving the global agenda could hurt international order. Joining us now, we've got Ian Bremmer, Eurasia Group's founder and president. Ian, thanks for being here. So to what extent does Trump's presidency fuel that top risk for you of a fragmented global leadership agenda?
It's the most recent development, but I mean, it's more of a symptom than it is the underlying causes. The underlying causes have been coming for a long time. It's the fact that when the Soviet Union collapsed, Russia wasn't integrated into the West, and Putin blames the United States for that and now has an alliance with North Korea and Iran. It's China being integrated into the global economy, but not aligning with Western values, not opening its political system, certainly not becoming more of a free market economy, and the West not being happy about that. And then finally, it's people across the advanced industrial economies, especially in the U.S., that are no longer prepared to support the U.S. being the global sheriff or the architect of free trade, or even the promoter of democracy, because they don't think that their leaders work for them. And so, as a consequence of those things, one of the things you get is much more unilateralism, much more rejection of that old U.S. exceptionalism and leadership in a multilateral way, supporting rule of law. And Trump is a huge symptom of that. So the answer to your question is yes, but there are things that have been happening that make that the reality we have today. And so now you have a law of the jungle, which is great if you're the apex predator, but my God, it's a real problem for everyone else playing defense.
And Ian, talk to me a little bit about how the U.S.-China relationship then plays into all this. If we do see a further breakdown of relationship here between the world's two largest economies, just some of the risks that then poses, and how you're expecting Trump maybe to handle some of these engagements.
Yeah, I think we do expect that the U.S.-China relationship is going to break down from what has been a relationship of no trust under the Biden administration, but nonetheless a lot of effort to stabilize the relationship. Just in the last year, some 25 high-level bilateral channels being established and regularly engaged in, from the economy to technology and climate to military relations. I expect those will mostly break down. And Trump fully intends to put significant tariffs on China in the early weeks of his administration. I think we'll also see a significant tightening of export controls in technology and an expansion of areas of the economy that are seen to be relevant to national security and therefore should be decoupled. You'll also see pressure from Trump on other countries that are acting as pass-throughs for Chinese manufacture. The only part of their economy that's working is that export sector into the United States, especially Mexico, but also India, also Vietnam. Now, Trump is always interested in cutting a deal. And remember, he's the only president that ever invited a Chinese leader to the inauguration, even though Xi Jinping's not going to come. So, I mean, they are going to have conversations, and I suspect there'll be talk about, hey, Trump is willing to talk to this guy. Might they figure something out? But what the Chinese will offer in response will be nowhere close to what will be required to back the Americans down. So, yeah, these are the two most important economies in the world, and I fully expect that the relationship is not only going to head towards a trade war, but will also have a feeling of increasing Cold War that other countries in the world that want to do business with both are going to have a hard time navigating.
Ian, I quickly want to get your take on some news crossing the wire here. Trump will not get jail time or probation in his New York hush money case. It reminds me of your call on a lack of checks on Donald Trump heading into the next 4 years. What's your reaction?
The United States is not going to become a dictatorship. There are plenty of checks in ensuring that the republic stands, like a professional military and an independent judiciary, irrespective of who appoints them, and a federal system. I mean, the elections, of course, are managed at the state level, not at the national level, so very hard to actually rig. But Trump's strength compared to 2017, the consolidation of his appointments, of his cabinet, loyalists as opposed to establishment Republican figures, and the fact that the GOP desperately needs his coattails and not the other way around, means that he's more than capable of hitting his adversaries hard in the face and backing it up. And you will see others around the world that will appease him. Mark Zuckerberg in the United States, perhaps the most well-known appeaser in the last couple of days, changing his business model, community notes, and now he's all in favor of free speech. Why? Because Trump and Elon won. And if you think that Mark is backing down and kissing the ring to Trump, you haven't seen anything compared to the Danish prime minister, given the Greenland challenges, or Panama, or other countries around the world where Trump is he's beating up on much weaker people than much weaker countries than the United States, and then him and Elon, and that's going to play out in a very volatile way. A lot of furniture is going to get broken over the course of this administration.
Ian, let's talk about Trumponomics, because I thought you had some great things to highlight here in this risks report. When you talk about Trump heading back to the White House here for a second time, he's coming at a time, we just had the jobs report out this morning, showing once again that the labor market remains strong. It's very resilient, yet we are still dealing with sticky inflation. How do you see some of his policies, like tariffs, affecting the economy here in the years to come?
Well, first, I believe that he is going to implement a lot of these tariffs. I don't expect it'll be 60% across the board on China. It might end up being an average of 25% or 30%, but that's still meaningful in terms of impacting corporates, reducing profits, and increasing prices at home. He won, and the Democrats lost on the back of immigration, top issue. Everybody is angry about the level of illegal immigration that has not been adequately dealt with in the United States by Biden and by Harris. Trump absolutely will deport. I wouldn't be surprised if we see 1 million illegal immigrants deported from the U.S. in the first year. That will lead to more jobs for Americans. But as you say, the job market's pretty hot and labor rates are already up. So, I mean, that's going to lead to more costs. And by the way, illegal immigrants are working illegally, but they do pay tax and they do consume. So that's also taking money out of the U.S. economy. So I do think that these things will lead to constraints and that the markets have not adequately priced that in. There will be positives. Trump will, of course, reduce regulatory authority, and DOJ will do what they can to increase efficiency for the private sector. And you'll also see an extension of the 2017 tax breaks for corporates and for high net worth individuals. But most of that low-hanging fruit has been picked. And as you say, the macroeconomic environment, not just on inflation, but on interest rates, on debt, as well as on higher multiples that stocks are presently trading at, just makes it more challenging to get everything right. So I think the consequences of Trumponomics are more serious than people think.
Ian, it's always great to get some of your time. Thanks so much for joining us here on Yahoo Finance. Hope to have you back again soon.
My pleasure.
On the other side of the break, we'll be speaking with investor and Shark Tank star Kevin O'Leary about his bid for TikTok. We've got that and much more coming up next on Catalysts. The Supreme Court is hearing arguments right now in a decision that will dictate TikTok's future here in the United States. Unless the court decides otherwise, TikTok has until January 19th, less than 10 days from now, to sell its U.S. assets. And Project Liberty, led by Frank McCourt, wants to buy TikTok. The group submitted a formal proposal to ByteDance on Thursday. Kevin O'Leary, O'Leary Ventures chairman, is a partner here in Project Liberty's bid to save TikTok, and he joins us now. Kevin, thanks so much for taking the time to talk to us. Great to see you.
Great to be here. Thank you.
So you delivered the proposal to ByteDance. What can you tell us about the details of that proposal and whether or not you've heard anything from them yet?
Well, we did this intentionally. We press released it on Monday of this week to make sure the justices knew that the company had an option to sell it without the algorithm. It was widely believed in the market that no bidders would emerge if the algorithm wasn't for sale. ByteDance has been clear that the supreme leader of China will not sell the algorithm. But we wanted to make it clear as they debate starting 10 minutes ago that we are a buyer. We've got a valid syndicate. We're prepared to put up as much as $20 billion. And we don't need the algorithm. We don't want the algorithm, obviously, because the order of Congress is forcing them to shut down because of the algorithm. It's Chinese spyware. Pretty well everybody knows that now. And it's not really an issue around free speech because if they sell it, we'll keep it lit up, and we want to. And certainly for me, the majority of my companies, up to 60% of their digital spend each week is on TikTok. It's a very effective platform. And I want to make sure as an advocate for American entrepreneurship that we keep it lit up, which is why I got involved in this in the first place.
Kevin, 20 sounds low to me. How do you get to 20?
You don't know yet because you don't have the numbers. Everybody's just assuming revenues somewhere between 7 and 10 billion. I don't know how many of the existing U.S. institutional shareholders are going to roll into the new deal. That will not require cash. Obviously, it'll be more than 20 billion if they do require cash. We just don't know. If I were an existing shareholder right now, and I'm looking at the wall of two options. Remember, I'm a shareholder in ByteDance, and let's call ByteDance 10 to 15% of its value is inside of TikTok USA. And so if all of a sudden they just shut it off, because that's an option the Supreme Leader can do, you're erasing about $38 to $40 billion worth of value from me as a shareholder just because the Supreme Leader had a bad hair day, just didn't want to play ball. Now, I think that's highly unlikely that because the cost of capital to Chinese deals after that will skyrocket because people don't trust that they're going to be treated fairly as shareholders. So they spin off that asset into the U.S. and then our syndicate buys it and we operate it according to the order of Congress. Now, the timing is really complicated here because we're talking as the justices are debating. Out of this debate in a few hours, we will find out the direction. If they turn back the case, in other words, they don't want to hear it, it goes back to the executive. That is Biden. Biden then looks to the market and says, is anybody willing to buy it? Should I give them a stay of execution of 90 days? And then he would say, yes, because I see that Project Liberty is willing to do it. McCord and O'Leary, they'll buy it. Then I'll give them 90 days to work it out. And then, remarkably, just a few days later, at 12:05, we're now operating under the administration of Trump, the new president. So we have to work with yet a new administrator on the deal. I've never been involved in a more complicated deal in my life, but it is a legacy opportunity, and I'm really excited about it, and so is Frank. And we have so many great plans for this platform. We're going to clean it up, make it better. And I think, you know, they're stalled out 170 million users. Why don't we have 200 million? We can do that by just letting people feel safe. They can put it on their phone. Many people won't put it there because they know it's Chinese spyware.
Kevin, have you heard anything from ByteDance?
Well, you should make the assumption, you know, I got to be very careful here. You know, I'm not going to answer that question, but you should make the assumption that in order for them to know there was an offer, we found a way to get it to them. So you just, you know, the thing is, I know all the shareholders. So does Frank. We know who they are. We've known that for 2 years. I know them personally. So that's the answer.
Kevin, you also need President-elect Trump to get this done. And I know you've had a lot of conversations with him. You were recently spending some time with Trump. What have those conversations been like? And I guess how confident are you that you will be able to get this done under the Trump administration?
My first conversation with Trump was the night before the Senate hearing that passed this bipartisan bill to ban TikTok, that far ago. I have not stopped talking about it with him because I know we're going to have to work with him. There's no question about it. I was at Mar-a-Lago last weekend. I'll be there this weekend. This is a top agenda item for Frank and I. We pooled our resources together to put this on. We know we have to work with both administrations. This is a bipartisan effort. We don't care if you're running a business on TikTok, 1 to 3 million is the average. There's about 6 to 7 million small businesses generating reportedly up to 10 billion in revenue. We'll find out when we see the books in the data room. But many of them are Republicans, many of them are Democrats, but they're American entrepreneurs. They represent 62% of job creation. Businesses between 5 and 500 create 62% of the economy's jobs. So I care a lot about them. I don't care about the politics. So we really need to make sure that we are on side with regulators in the current administration, which is Biden till midday on the 20th of January, and then work with Trump. And we are. We're making sure that both sides know, and I'm in that narrative with him whenever I can be. You know, the amazing thing about Mar-a-Lago, somebody asked me this week, why aren't you booking your travel to Davos? And I said, I don't need to. Davos has moved to Mar-a-Lago. I can meet everybody I want in Mar-a-Lago. It is the new Davos. I met the Prime Minister of Italy was there when I was there. This place is the center of the universe if you want to get stuff done like a TikTok deal.
Kevin, given that you're calling Mar-a-Lago the new Davos, was this recent trip your bid to be part of the Trump administration?
No, I don't need to be part of the Trump administration. I need to work with them. I'm very busy doing what I do, and everybody knows what I do. I support American entrepreneurship, regardless of what their politics are. People mistake something that's very important. The number one export of the United States is not technology or natural resources or gas or oil. The number one export is the American dream. Everybody wants to come to America to start a business and become personally free. That's why people drown in rivers trying to get here. I support and am an ambassador for the American dream. That's what I do. So of course I have to work with Trump. And by the way, I know he feels the same way about it. No, I don't need a role in the government. I need to work with the government to get stuff like TikTok done and make sure that the regulatory environment is pro-business, which is why, I bash on Gavin Newsom so much, the mess that California's in, even before the fires. I want every state to be competitive. The reason I live here in Florida is this is a very pro-business state, in case people hadn't noticed.
Okay, well, talk to me about, it's interesting that you talk about the kind of pro-growth outlook for the U.S., but one of the big questions is whether or not Trump's tariffs are going to be inflationary, potentially hurting small businesses. Have you spoken with Trump about those tariff proposals, and just what is your take on the economic impact as an investor?
Well, let me go to 30,000 feet and explain the whole thing this way. We've been listening to Donald Trump for over 12 years. And it's very important to learn something. When dealing with Trump and trying to understand his motivations, because he's a very transactional guy, he's very specific about this. And he's very transparent and he's very open and he believes in relationships with people. I don't think there's anything wrong with that. But you have to be able to distinguish between the noise and the signal. When he says something like, I'm going to buy Greenland, or I'm going to buy Canada, that's the noise. The signal is I want a better economic union. With Canada particularly, we could create a powerhouse by combining economics, maybe a common currency and a common passport. He's not saying, I want every Canadian to give up their citizenship. That's the noise. And he's very bombastic. He says outrageous things, but you have to pull the kernel of opportunity out of everything he says. That's what I focus on, the signal. And it served me very, very well.
Kevin, talk to me a little bit more about that merger, the talks there between U.S. and Canada. I know you've been vocal saying that, hey, maybe this is an idea that does make sense. Walk me through that, just economically speaking. Why would that be advantageous for both countries?
Well, think about it. This is the longest border on Earth with the largest amount of trade, 1.3 trillion, 188 billion just out of Alberta, shipping energy to the United States, the number one exporter or importer of energy, between these two partnerships. So that's the trade deficit there. Trump talks about a $200 billion trade deficit. It's all oil that's being imported in the United States. In fact, Alberta has more oil than the entire United States, and gas. And so that's a partnership that gives energy independence, number one. Number two, all the goods and services. I mean, Canadians and Americans are almost original DNA. They're almost the same with cultural differences, obviously, and nobody's saying give up your citizenship. But why wouldn't we create something as powerful as the economic union in Europe? Why wouldn't we do the same thing here and tell the rest of the world, listen, we've put our economies together, and I'll give you some specific examples. A common currency. All of the commodities, and Canada's so rich in them, whether it's precious metals, or water, or oil, or whatever, gas, are denominated in American dollars. Every Canadian has an American dollar account. So why not just say, we'll have a common currency. Maybe you give the Bank of Canada 2 seats on the Fed, details to be worked out. And all of a sudden, you're trading goods and services in one currency. Check that box. Number 2, eradicate all tariffs, not just North and South, East and West. You take Vermont, for example. There's a barrier between Vermont farmers selling dairy into Quebec, just north of them. And Quebec is subsidized by Alberta with a milk board that pours milk away after Alberta gives them $5 billion to subsidize them. That's just sheer stupidity. So erase all that so that all of a sudden, maple syrup, $1 billion business every quarter, controlled pricing out of Quebec. That's Vermont farmers who tap maple trees are really pissed off. Get rid of that too. Wine in California can't be shipped to British Columbia. British Columbia wine can't be shipped to Ontario. You get to see what I'm talking about. Eradicate all of that, and the productivity goes through the moon. Here's how you control immigration. Let's nickname it the Uni. This is a passport that's issued to any American citizen in good standing with the American government and has a passport, or any Canadian citizen in good standing with the Canadian government. Each government gets a say on whether a unifying passport is issued to that individual. That individual can then travel and live anywhere they want, any province, any state, and they pay one tax rate, 21%, let's just say that, with no deductions. And so people will really find that attractive, but it's even better. You start to control immigration. You want to go to MIT? You got to get a uni. Why do you want that student to get a uni? Because half the students at MIT going into engineering, very valuable students, we kick them out of the country when they graduate. What are we, idiots? We should bring their whole families over if the background check works and keep them here working for our economy, not kick them out. Same with Waterloo Robotics up in Canada. On and on and on and on.
Yeah.
All these ideas do not have you giving up your citizenship. So everybody should chillax and understand with what Trump is saying.
Okay.
Forget the noise, focus on the signal of opportunity.
All right, Kevin, since you mentioned the macro backdrop, I want to get your thoughts on the market because we did have that unusually strong jobs number coming in today. You're seeing a rise in yields, a sell-off in stocks. As an investor yourself, are you bullish or bearish in this macro environment that's really confusing for a lot of investors?
I'm bullish. You know, job creation is the mother's milk of earnings, period. And so you get the volatility as bond prices adjust to reports like that. But when you have a growing economy and your unemployment rate is under 5%, things are booming. Remember, just 6 months ago, we were talking about a recession. No recession here. Now, what this means is no more Fed cuts for quite a while.
Right.
So obviously, I have to get over that. But I love the fact that there's an optimism right down to the C-suite of large businesses and small alike. In many of my companies now, we're going ahead with CapEx expenditures because we feel confident about the economy, and that manifests itself in more jobs. This is good news, not bad news.
All right, Kevin, really good stuff. It's interesting to hear that you're increasing your CapEx as well, because we have not necessarily seen that strength across the board from corporations. Thank you for joining us, Kevin O'Leary. Really appreciate it.
Take care.
Coming up, we're looking at today's Yahoo Finance trending tickers page. We'll give you the news behind those moves next, right here on Catalysts. We're looking at stocks falling this morning after that stronger than expected December jobs report. The Nasdaq still the biggest loser of the major averages, down over 1.5%. Markets have been volatile to kick off the year. So how should investors be positioned? Our next guest says that he has top picks for the year, 5 of them. The first being cash, then software company Cisco, the bank ETF KBW, and the S&P mid-cap value ETF IJJ, and lastly, networking company Adtran. Here to discuss, we've got Dan Niles. He is the founder and portfolio manager at Niles Investment Management. Dan, we want to get into these top picks, but it really stuck out to us that a big tech name is missing from this list, and that's NVIDIA. Why is NVIDIA not in the list this year?
Well, we've been talking about this really since mid last year, and we put out a post on this earlier this week, which is you've seen really strong AI spending on infrastructure over the last 2 years, and obviously NVIDIA has been a big beneficiary of that. But we've been talking about this for a bit now. We think there's going to be a pause or digestion phase in AI spending as you get into 2025. And a good example of this is Microsoft. Microsoft on January 3rd put out a press release, put out a blog post that they were going to spend $80 billion in CapEx. And everybody was, oh my God, that's great, that's a big number. If you actually work through the math on that, they spent $20 billion in CapEx in September. They guided for that to go up in December. Microsoft's fiscal year end finishes in June. So that means that in the first half of their fiscal year, they're going to spend over $40 billion, which means in the back half, it's going to be actually under $40 billion. And so your growth rate on CapEx just from Microsoft goes from nearly up 70 to 80% year over year for the last year and a half, will go to basically zero by the time you get to June. And so that's just, and by the way, they're the biggest CapEx spender on AI infrastructure that exists. Obviously, they have that relationship with OpenAI that helps drive that. And that's not something that people are focused on. So that's the big reason NVIDIA or any of the Mag 7 are not on this list going into this year. And that's also, by the way, why cash started off the top picks, because I think a pause in AI spending, when you've got so much of the stock market related to AI, and your first question out of the gate was on NVIDIA, which shows how much focus there is on it. That's going to be a drag on the market if there's an AI digestion phase coming.
Dan, before we dig into your pick specifically, just zooming out just a bit and just taking a look at, we have the inauguration happening in just over a week from now. Trump policies when it comes to the influence of some of those larger cap tech names that you've just listed, is it a positive for that group, a negative? I guess, how are you evaluating that? I know you're very, very focused on valuation, where we're seeing play out more so in the market dynamics, but how does policy fit into that?
Well, policy fits into that in the sense of, well, what sectors does that favor? So if you approach it from that standpoint, really over the last 5 years, it's really all been about AI or internet infrastructure, starting with COVID, where internet infrastructure was the big investment, then you have AI. Well, what's Trump focused on? He's focused on deregulation, cutting taxes. And that benefits more of the small and the mid-cap type of names, because the biggest companies in the world, they get very low borrowing costs. They don't care. They don't need a tax rate, and they can, to go much lower, they can amortize fixed overhead over big amount of revenues. The smaller and mid-cap names, they don't have that advantage. So for them, this is very helpful. And then you look at the multiples, especially in the value sector of this, those multiples for value, small and mid-cap, traded about 17 or 18 times trailing PE. The S&P 500 trades at 25 times because the biggest stocks have driven the market up so much over that period of time. So if you look at it, for example, over the last 5 years, the S&P is up about 82%, but the small and mid-cap sector has actually underperformed that by 35 to 49%, which is why you have this wide disparity in the valuation between the two. And in an environment where the Fed, and I started this year saying, I think there's a close to a 50% chance the Fed doesn't cut at all, and they could potentially raise. And with the jobs number this morning, that's even more likely. I think you've got to really start thinking about these policies really benefit stocks other than the S&P 500.
Well, let's end there, Dan, because your top pick for the year is cash. How risk off should I interpret that pick being?
Well, I mean, the last time I picked cash as a top 5 pick was in 2022, and the S&P went down 19%.
Key
and
indicator.
You got pummeled on. Yeah, and you got pummeled on bonds as well because remember, inflation was going up. So yes, given that and given what I've written, which is I think the upside in the stock market, if everything goes right, is it's up 10%, but the downside is down 20 to 30 because multiples compress because inflation comes in higher than what we're thinking and the Fed doesn't cut, in fact, pauses or raises, then yes, obviously, cash is in there for a reason.
All right, Dan, thanks so much for taking the time. Unfortunately, we have to leave it there. Hopefully, we can have you on again soon. Dan Niles, thanks so much.
Thank you.
Got much more on your market action ahead. Stay tuned. You're watching Catalysts. BCG survey of top CEOs finding 3 potential economic headwinds for 2025. So here's what's top of mind for some of the biggest business leaders across the globe: a softening labor market, emergence of unsustainable growth sources, and an unwind of elevated asset prices. Here to talk about that and more, we want to bring in Rich Lesser. He is BCG's global chair, joining us now for more on what he's hearing from the C-suite. Rich, it's great to have you. Thanks so much for taking the time to join us here on Yahoo Finance. Give us a better sense of those conversations, because it's interesting to me that a weakening labor market is top of demand, and then squaring that with the once again very, very strong print that we got out this morning.
Well, first of all, you do these surveys and then you see real data. So what people worry about isn't always what materializes. I'd say most people believe the base case economic strength is quite good. That's certainly what we would say. But they also see a world of just so much risk and uncertainty, so that, there's a base case view that's pretty positive. The way I express it is higher base, higher beta. The higher base is we've got a strong baseline economy. If there's some deregulation, if there's some other things, that should continue to keep a strong base. But the uncertainties, tariffs, labor markets, geopolitics, interest rates in a world where inflation isn't cooling as fast as we would want, and that's reflected in the market today, put a higher beta around that too. And I think that's the reality most business leaders are trying to wrestle with right now.
To throw one more survey into the conversation, we also got that consumer sentiment data in showing that inflation expectations are rising for consumers. And it reminds me of this bifurcation we've seen in the data. You see a strong labor market, and then you have consumers not really feeling great about the economy. What do you make of that bifurcation? Has that come up in your conversations with executives?
Well, I do think people observe that consumers are not as confident as the underlying economics would suggest they should be when you just look at macro GDP data, unemployment data. I do think they're stressed. Some of that's overhang from the massive uncertainties that consumers have felt as well over these last 5 years. It's almost exactly 5 years ago that we entered into this COVID period and all that's happened since then. And I think some of it is, they also pick up the news and the uncertainties of what would a tariff mean? What would labor shortages mean if there's deportations? Like policies that we honestly don't know what they're going to be, how effectively they'll be implemented, that could create upsides, but could also create challenges. And that plus lingering uncertainty, I think, is reflected in consumer sentiment.
Rich, talk to us about how AI fits into all this. It's top of mind for investors when it comes to investment opportunity. It's top of mind for business leaders. They're trying to find out ways to best incorporate into their business, obviously try to make themselves a bit more productive. What do you see as the biggest impact it's going to have, not only on productivity, but on from a labor force standpoint, and how you see business leaders navigating this change?
Right. So I'm going to focus more on the 3 to 5 year horizon. There's obviously AGI and all the things that could play out over 10 or 20 years and what that could mean. I think in the near term, there's really substantial upsides from AI, both to help individual businesses perform better. And by that, I also mean the revenue side, not just the productivity side. In fact, we've seen some very interesting things clients have done where they, for example, work on customer service, but instead of using it to have fewer customer service reps, they use it to allow their reps to be better enabled to serve their customers and to give them more time because a lot of basic requests can be handled through technology. We see that in multiple areas: engineering, customer service, marketing and personalization, research, development, many different places. And in a time when labor markets could be pressured, when we're looking to bring inflation down, this is pro-productivity, should be anti-inflationary as it rolls out. It'll take a few years to really broad base it across the economy, but that should be a real advantage. And I think for businesses individually, they are realizing that they have to be trying to find ways to lead on this. And some of them were already in that position before generative AI, and they are able to even go faster to leverage generative AI. And others were behind then, and they're finding it harder to catch up, but I think recognizing the imperative to do it.
30 seconds left. What is the biggest policy question you are hearing from CEOs about the upcoming administration that they really want clarity on?
Tariffs. I think that, it's such a huge implication. Baseline trade growth next 8 years globally is probably a little under 3%. But if 20%, 25%, 60% were implemented, as you put it here, the cost of importing goods would go up $640 billion. So, but we all know that may not be what's actually implemented. It may be a basis for negotiating other activities. So I think right now, for many businesses, particularly those in the real economy who are moving goods around, have global supply chains, don't know what the repercussions will be, how others will retaliate. I think navigating that whole issue is probably the number one uncertainty for many of them as they look to the months ahead.
All right, Rich, we have to leave it there. Rich Lesser of BCG, thanks so much.
Thank you.
We've got much more of your market action ahead. Stay tuned. You're watching Yahoo Finance.
We are watching Disney, Fox, and Warner Brothers after the media companies called off plans to launch their sports streaming service Venue. Yahoo Finance's Alexandra Canal joins us with more on what's behind the decision. Ali, I know you had a lot to cover this morning, but this is just one of the stories you were following.
Yes.
Tell us what we know.
A lot this morning and a lot this entire week, especially if you just think about this company or a company that was supposed to launch and then never did. Don't forget that on Monday, Fubo TV, the internet TV bundler, dropped its antitrust lawsuit against the launch of Venue. This was seen as a huge win, but it did coincide with the announcement that Fubo would combine its business with Disney's Hulu plus Live TV cable replacement service. So it seems like all the regulatory hurdles surrounding this had been diminished. But then in recent days, there have been reports that other paid TV distributors like DirecTV and Dish had floated possible legal action. So potentially there would have been more regulatory overhang pressuring this launch. In a joint statement, the three companies said, quote, "In an ever-changing marketplace, we determined that it was best to meet the evolving demands of sports fans by focusing on existing products and distribution channels." If we take a look at the stock reaction, Fubo shares had initially popped around 10% before erasing those gains. And then we did see shares of Disney, Fox, and WBD all down today. So it really remains to be seen what will happen next. Fox has a huge presence in the sports world. A lot of those major games are already on broadcast. Disney, of course, has its ESPN fully over-the-top streaming service debuting later this fall. And now with the Fubo combination, even more sports exposure over the internet. So to me, the big question mark is WBD. This is a company that's just going through it. It lost the NBA rights, splitting up its cable and streaming business, struggling massively with cord cutting, and Venue was an opportunity to really target the cord cutters, the cord nevers. Executives had estimated around 5 million subscribers by 2029. It was going to be priced at $42.99 a month. So this was very far along in the process, and you have to wonder what was happening behind the scenes that ultimately led to this decision, especially since Fubo did drop that antitrust complaint earlier this week.
Certainly. All right, Ali, thanks so much. Let's turn to Tesla. Tesla officially launching a new version of its Model Y, just in China, though, with an updated exterior and upgraded features inside. The new model costs about 5% more than the previous version in China. It costs roughly nearly $36,000. Deliveries are set to begin in March. Lots of talk on the internet here, the reaction that we're getting to this, comparisons being drawn to this new Model Y, and maybe Tesla trying to make it look a little bit more like a Cybertruck. I don't necessarily see that comparison. We do see a little bit of a revamp here when it comes to the lights, but some of the other things to note within this is that this refreshed Model Y has a longer driving range on a single charge and a faster acceleration speed. Obviously, Tesla doing all it can to better compete with some of those domestic players.
Yeah, it's really interesting given that we already heard earlier this month from Tesla that they had that decline in overall deliveries for 2024. To see them rolling this out only in the Chinese market, they're not launching it globally, but certainly an incentive for buyers. That price point, also a 5-year zero interest financing plan for the Model Y, so a lot of incentives there. Coming up, we've got wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're an hour into oral arguments over a potential ban of TikTok. We're going to set up users with the key tips that you need to navigate a ban. And it's Jobs Day, and we're joined by a LinkedIn career expert who will talk about which jobs are on the rise this year and set you up with 3 pieces of advice for your career search. Plus, mortgage rates closing in on 7%. We'll discuss where rates could go this year and give you a few pointers for your weekend home shopping. All that and much more. But first, let's take a look at some of the market action. We're 90 minutes into today's trading session. Stocks falling after a stronger than expected December jobs report. Joining me now, we've got George Cipollone, who is the Penn Mutual Asset Management Portfolio Manager. Great to have you back on the program with us, George. How are you seeing the state of the labor market play out in the equities market right now?
Great to see you again, Brad, and Happy New Year. So, yeah, the jobs market was, or the jobs number today was certainly a stunner. It came in almost 100,000 jobs higher than expectations. And then you saw the progression in the markets. Number one is the bond market, and we saw Treasury yields spike. And then number two is the stock market, and we saw the stock market fall. The reason why that progression is important is because right now it's all about rates, rates, and rates. It's about the level of rates, the term premium within rates on the longer end. It's about the velocity of the move and expectations. And so all those things happening at the same time, the sharp move up, is really not great for the stock market right now. It's not great for valuations. And we're seeing that throughout the market today.
You say that some sectors are being left behind as we continue to see ultra concentration in tech. What are those sectors that are being left behind?
Yeah, Brad. So if you think about we all talk about the Mag 7 and those 7 stocks that have done phenomenally well over the past handful of years, especially last year. So what it's doing is causing a group of not so magnificent sectors. And those sectors tend to be small cap versus large cap, value versus growth, and then international versus U.S. And it all stems from the same performance dynamic of the S&P being driven by these just few handful of stocks. Now, as stock pickers, we kind of like that because, a lot of stocks are getting left in the dust. They're not making headlines every day. And there's some really undercovered gems out there. So in our fund, for example, our top 5 holdings, best performers last year, 3 of them were up over 100%, and 3 of them were small caps. And so we like that, and we like to uncover some of those gems, and we'll get that in a market that is this divergent.
What do you believe the sweet spot is for investors right now, trying to find perhaps, and dare I say, cheap stocks, but with future paths to growth, and where are those areas?
Yeah, you're right, Brad, because that's the thing. We cannot pull apart value from growth at this point in terms of a story for a stock if you really want to buy one. You can't buy just cheap, for example. If you buy just cheap, you will get left in the dust because the market isn't reflecting any value in those names because they want to see growth. They want to see some top line growth, some margin expansion. And if they don't see that possibility, they'll stay cheap. So to your point, where are we going to look? First, we're going to look for cheap, but then we have to dig in and then try to find some value. So I do think there's a few different areas, even within tech. As a value investor, what we're seeing is these huge CapEx numbers from Microsoft and Amazon, and it's totaling up to $300 billion in the next year. That money is going to go somewhere, and it's really good money from companies that have great balance sheets. So there's kind of this halo effect outside of the big names that everyone's heard of, and there are a lot of smaller cap names where I can't name individual names that we own, but there are a lot of individual names that you can find there in small and mid caps that should benefit from that CapEx spending, which again, if you segment out the bubble aspect of and the fervor in the market from the underlying fundamentals, you can kind of tie it all back to that CapEx number, and that's what we're going to do next year.
Okay, so steering clear of individual names. Switching gears, though, many sectors are likely to be hit by President-elect Trump's proposed tariff plan. And you're watching 2 specific companies that are likely to be affected, or at least the qualities around those companies that could give us a signal for some other names that could be affected. What are those?
Yeah, so if you think about on the international side, and we're seeing it in manufacturers. So again, I'm trying not to name the specific companies, but we're talking about manufacturers here that again are going to have to import into the U.S. If you think about automakers, for example, just about every automaker outside of the U.S. is having a really, really hard time. If you think about the impact of increasing competition from China and now the potential for higher tariffs into the U.S., that's really hurting a lot of global auto companies right now. And that, again, that can extend to other manufacturers that import into the U.S. Now, again, there's a lot of rhetoric out there regarding tariff talk, and I think a lot of it is more of a negotiation ploy than it is going to, actually hit. But yeah, that's what we're focused on today. We're worried about certain companies that may get impacted. But inside the U.S., I do think a lot of companies, a lot of smaller cap companies that make in the U.S. and sell in the U.S. should do pretty well.
George, all right, judging by your background, I think it's safe to say, go Birds. Good to see you, George.
Let's go, Brad. Thank you.
All right, see you soon. Now time for some of today's trending tickers that we're tracking. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Wayfair shutting down its business in Germany effective immediately. The company expects to spend up to $111 million as part of the restructuring, with most payments happening over the next year. Around 730 employees will be impacted, and half are expected to shift to roles in other offices. Money saved from the move will be reinvested across the company's core initiatives to cover and over the rest of the year. And next, D-Wave Quantum announcing fiscal year 2024 bookings will exceed $23 million. That is a 120% jump from last year. And this comes as Wall Street continues to seek out good news on the AI front, looking for companies' ability to monetize AI. Finally here, we're also tracking Constellation Brands falling after it fell short of a number of third quarter metrics. The alcohol beverage company cutting its annual sales forecast and reducing the lower end of its profit range. The company's president and CEO, Bill Newland, citing subdued spending and value-seeking behaviors from consumers. Well, Treasury yields rising to their highest level since November of 2023 after a stronger than expected November jobs report. Yahoo Finance's Julie Hyman joins me now to explain exactly what's going on. Hey, Julie.
Hey, Brad. Yes, indeed. We have been seeing yields push higher and higher here. Even before this jobs report, we have been seeing the yields flirt with those levels that they hadn't seen going back to November of 2023, and they just keep on going higher today. There was a little bit of a hint of this earlier this week as well when we had the Institute for Supply Management Services report. As part of that report, there's a prices paid component, which is a measure of inflation. So we got that earlier this week, and if you can see here, basically we saw it go higher, right? So raising a little bit of concerns about inflation re-accelerating. This is something that Torsten Slok of Apollo flagged in a chart earlier this week, that prices paid component tends to lead headline CPI. So you take some of these indications of inflation showing that in some cases it's either not slowing down or even re-accelerating. You add to that a hot jobs report, and what you get is a lot of concern about inflation re-accelerating. So if you look at some of the reasons behind the recent rally in bond yields that is continuing today, this morning Greg Dacco was on the program in reaction to the jobs report, and he reiterated some of these issues. He talked about, of course, inflation and those concerns about inflation, and then layer on top of that the expected fiscal policy of the incoming Trump administration, which is being seen by many economists as something that can further potentially fan inflation. We're talking about tariffs and things like that. Then also that expected fiscal policy could potentially lead to higher deficits as well if you get a lot of spending on the part of the incoming administration. For example, if there are further tax cuts that are passed. And then there is the risk premium. That's a buzzword that is getting a lot of attention within the bond world and the stock world. Basically, it is the premium that people demand to hold bonds over stocks. And it's been sort of wonky as of late. And perhaps some of the deficit and fiscal policy stuff is feeding into that. So what does this all mean? Well, not necessarily good news for stocks. And Steve Sosnick of Interactive Brokers was on the show this morning as well, and he talked a little bit about that phenomenon.
If the bond rates are rising because of inflation fears, because of just general concerns, because of just general malaise, that ultimately does weigh on stocks. And so there is a number at which high bond yields become a problem for stocks, but it's a fluid situation, and it can be very dependent on market psychology.
So to that point, last year, yields were climbing higher, even with the expectation for rate cuts early last year. it wasn't necessarily problematic for stocks. It didn't become more problematic for stocks really until the latest leg up in bond yields. And we saw that happen kind of in early December. Now, the 10-year yield is up about 100 basis points, 1 full percentage point from when the Fed began this recent cutting cycle. And it's up about half of that amount just in December alone. At that same time, we started to see stocks sell off, of course, from their highs. So these higher bond yields aren't always problematic for stocks. It depends on the underlying reasons why the bond yields are going higher. And it seems like, to cite Steve's fluid situation, we are in such a fluid situation at the moment. We'll see what ends up happening as we start to get, for example, more inflation data, and as the Trump administration starts to roll out some of the things it's been talking about, Brad.
Julie, I never thought a bond market explainer would need a Hammond B3 organ behind it, but you need a strong case for it here today.
Thank you.
Appreciate it. TikTok in the hot seat today in the highest court in the land. Lawyers for the social media app arguing in an emergency hearing ahead of a key January deadline that the ban of the app violates free speech.
The government's real target, rather, is the speech itself. It's fear that Americans, even if fully informed, could be persuaded by Chinese misinformation. That, however, is a decision that the First Amendment leaves to the people.
A final decision is not expected today, but we want to get TikTok users prepared with everything they need to know if a ban does go into effect. We're going to get answers to questions like what happens to TikTok on your phone, how do you save videos, and where do you go if you can't scroll TikTok. Here with more, we've got Abrar Al-Hiti, who is the CNET technology reporter. Abrar, great to have you here with us today. So let's just start with the first big question that might be knocking around folks' minds right now. What happens to TikTok on people's phones if the app is banned?
So come January 19th, if TikTok gets banned, it's not going to magically disappear from your device. Instead, you won't be getting updates, which means that over time it becomes more laggy and then eventually unusable. You need those updates to keep that running smoothly. But then after January 19th, if TikTok gets banned and you don't already have it on your phone, you've missed the boat. You will not be able to download it anymore. Companies like Apple and Google would be fined for making it available on their app stores. So really the clock is ticking, and pun intended.
So how can people save their videos on TikTok?
When you are going on TikTok, and this works for your videos, for other videos that you've seen other people post, there's a little arrow on the bottom right of the screen. When you tap that, you'll see an option that says save video. And I use this a lot, including when I send videos to people who don't have TikTok. It's a good way to just have that stored on your device. And if TikTok goes away, then that will all be safe. And the same goes for drafts. You can also go into your drafts, and there's a button where there's on the side, again, you'll see an arrow where you can go ahead and hit save as well.
So let's talk about some of the alternative platforms. Where are people expected or anticipated to go to? There's a lot of changes that have come forward over the course of this week in some of those other competitor platforms.
The obvious choice is Instagram, because Instagram over the years has really tried to beef up Reels into being a strong TikTok competitor. So that's where a lot of creators already have a platform. They kind of post to both Instagram and to TikTok. Facebook Reels is a similar idea. You can post across both Facebook and Instagram. It's the same company. But YouTube Shorts has also really been taking off. I've personally noticed when I go on YouTube, a lot of Reels are being pushed out because people want that bite-sized content as well. We all have really short attention spans, unfortunately. And then there's also Snapchat's Spotlight feature. This is a tab within the Snapchat app. It shows short form videos as well. Then there's Triller, which is similar to TikTok, lets you bring music and videos together, offers in-app editing. And then Byte, which was actually developed by the co-founder of Vine. This has a bit more limited editing features and music options, but also kind of that similar dynamic.
And finally here, there's a bid to buy TikTok from Project Liberty, and it's led by Frank McCord. If TikTok is sold, any idea what the platform could look like? I mean, we've had Kevin O'Leary Ventures chairman. He's a partner in Project Liberty, and he was on our show earlier today. He talked about getting rid of the algorithm. I just want to play this quick clip and then get your reaction on the other side.
We don't need the algorithm. We don't want the algorithm, obviously, because the order of Congress is forcing them to shut down because of the algorithm. It's Chinese spyware. Pretty well everybody knows that now. And it's not really an issue around free speech, because if they sell it, we'll keep it lit up.
I mean, even users have lauded TikTok's algorithm. So what does it mean if it does not have the same algorithm and if that needs to be built from scratch?
The algorithm is what makes TikTok TikTok. It's what's made it so successful. No one else has really been able to replicate it to that level. So losing that would be a really big deal. It's easy to say we can just go ahead and rebuild it, but that's not going to be an easy process, because if it were, then platforms like Meta wouldn't be competing so hard with TikTok at this point. So it's going to be an uphill battle if somebody does have to build that algorithm from the ground up, and the biggest hurdle for sure.
Abrar Al-Hiti, thank you so much for taking the time with us today.
Thanks for having me.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. We got the final jobs report of 2024 this morning, showing 256,000 jobs being added, driven by gains in healthcare, retail, and government sectors. But if you're looking for a job in 2025, what industries are set to see the most growth? According to LinkedIn, the top 5 jobs on the rise are artificial intelligence engineer, AI consultant, physical therapist, workforce development manager, and travel advisor. Joining us now on this, we've got Andrew McCaskill, LinkedIn career expert. Andrew, Happy New Year to you. Good to see you, my friend. Obviously, AI topping the list here. What skills are employers looking for in those types of roles?
Listen, I think that what we're seeing in the jobs on the rise, what we really wanted to do is that if you're looking for a job out there, and most people are thinking about their careers in January, new year, new me, and they are finding that it's really competitive. If you feel like it's competitive, you are not imagining it. It is tough out there. There were about 2.5 applicants per job on LinkedIn in the United States right now, and that's like up from 1.5 in 2022. I think that what the good news is that there's a lot of opportunity to have new experiences. Travel and live experiences have made a triumphant return, followed by like this post-pandemic travel surge. And the AI market size grew by nearly $50 billion since 2023 in the US alone. about half of the jobs on this year's Job on the Rise didn't even exist 25 years ago. So there's opportunities for folks with degrees because people are prioritizing skills over degrees right now. There are opportunities for people without those college degrees. And so I look at this list and there's really a balance between tech innovation and human connection. And that's what makes this job market so dynamic.
Andrew, Bloomberg Intelligence estimates that global banks will cut as many as 200,000 jobs in the next 3 to 5 years because of AI. How should job seekers be preparing for what seems like an inevitability at this point?
Yeah, I think, listen, it really is about skills. Now is the perfect opportunity to go out and start to get those AI skills. AI is going to be in everybody's inbox. It's going to be in everybody's life. And if you're thinking about jumping in, focus on learning the tech-specific skills. Think about AI certifications, data science, or cloud computing. You can do that with LinkedIn Learning. For every one of the Jobs on the Rise list, we have the skills that you need and free LinkedIn Learning courses that you can take through March that will help you understand those jobs, understand those skills, and talk about them. You're going to have to be really strategic when you're looking for a job right now. And I will say, across the bow, about 50% of what skills people are looking for are those hard skills. Those AI skills are going to be really, really helpful. Things like programming, data analysis, machine learning, sort of natural language processing, all of those things. But don't fret about that if that's not your thing, because the other 50% of what people are looking for are those human skills, communication, adaptability, leadership skills. You're going to have an air game and a ground game for this. And listen, there's also some real opportunities on the side that's not AI focused. When you look at something like a travel advisor being number 5 on the list or event coordinator being number 6 on the list, there's like all of these opportunities for people who want experiences now more than ever, whether that's a trip abroad or a gathering that makes them feel seen or celebrated. I think there's also some real opportunities here for people from underrepresented groups, for Black and queer professionals or entrepreneurs, because of their own cultural intelligence and their lived experiences that they're bringing to the table. A lot of these experiential and IRL sort of roles, your lived experience is essential in these industries. There is not an AI model or an algorithm that's trained on Black joy or the queer experience. So these are some opportunities for folks that if you're thinking about entrepreneurship or you're saying AI is not necessarily my thing or not on the tech side, there's some real opportunities for you to jump into the marketplace and have your skills be highly valuable, highly sought after, based on just identity alone. So there's good news in there too.
Yeah, really great points there. Give us your 3 tips to leverage your current skills in new fields.
You are not going to get a job in this economy through osmosis. So you've got to have a game plan. Number 1, identify your transferable skills. Switching industries is not starting over. Keep in mind, you can use things like LinkedIn Learning tools and courses to help you develop those skills that you have, talk about your current skills differently, and really jump into the game. Hiring managers, this signals to them that you really are thinking about these roles. And also make sure your LinkedIn platform, your LinkedIn profile is updated. Make sure that you're reaching out to your network. Then that part about it is increase your visibility. Invest some real time in building some genuine relationships. Relationships will save you sometimes when results won't. Join some LinkedIn groups, make some new connections, reinvest some time in your professional organizations. And cheat code, turn on open to work on LinkedIn. It will increase your visibility to recruiters by 2x. It's just an easy way to really hit the algorithm really, really hard. And the other thing too is I think hires are looking for those skills. Highlight your skills, get on the platform and start to interact and engage. Talk to your network about the fact that you're in the market and make sure that they know what to say about you to potential hires and that they're making connections for you. Finally, you gotta speak the language of the industry that you're trying to break into. Do some research on trends, follow news, then tailor your resume and your LinkedIn profile to align with that industry. It really shows to those recruiters and hiring managers that you're already thinking like an insider. And if you're looking at our new jobs on the rise list, there's videos under most of those jobs where people are actually talking about and explaining what those jobs are. It's an incredibly powerful tool for anybody who's in the job market right now.
Andrew, appreciate the LinkedIn algorithm hack. We were talking a lot about the TikTok algorithm, but the LinkedIn algorithm hack, that might be something that people can immediately put to work here. Andrew McCaskill, great to see you. Appreciate the time as always. If earning more is one of your 2025 resolutions, the answer may be a side hustle. Here's the advice Break Your Budget founder Michaela Alaka gave viewers on Monday.
Personally, I think that 2025 is the year of the part-time job, and not in a way where you have to completely overextend yourself, but in a way where you can figure out different opportunities or different paths to explore your interests and hopefully increase your income at the same time.
Apps like TaskRabbit are one way that workers can find those side hustle opportunities. And joining me now is Anya Smith, who is the TaskRabbit CEO. Great to have you here with us. So let's start there. What are some of the most popular gigs that folks are picking up on your platform?
Well, first of all, thank you so much for having me. So there are so many different types of tasks that taskers can do on our platform, including furniture assembly. Of course, we're owned by IKEA. So not only IKEA furniture, but all types of brands. There is organization, cleaning, TV mounting. There are multiple tasks, especially those around the home, that taskers can sign up for to help our clients to have better lives.
So break down the numbers for us. How much are these folks typically earning?
So there's a range. It often depends what metro you're in. So for example, in New York City, it's on average $52 an hour. Of course, in LA, it's quite similar. In the Bay Area, it's quite similar. I think the overall, the average earnings are in the 40s to $50s an hour. So it's quite compelling.
So as you think about the total number of people who are really accessing TaskRabbit and being able to be brought on for gigs, how many are doing this part-time versus full-time, and what you're seeing in the data?
So our data shows that about a third of our taskers are working on a platform full-time, but many people come in and do it full time for the summer maybe, or do it full time for a couple of months when they're in between other opportunities. And many people do it just over the course of years. And so we have examples of taskers who've been on our platform since 2020, since 2018. Emily has been on our platform for the last couple of years as a student in Boston. So of course, the cost of living in Boston is super high. So she tries to augment her time with doing tasks around Boston area to earn some extra money. We've got retirees who have been on the platform for many years who are also trying to earn extra income. So there are many different ways that people are using the platform to earn something more meaningful to them.
You noted 3 long-term trends that you're watching in the gig economy at large here. I want to know what those trends are and how you anticipate them playing out in 2025.
So yes, there are 3 trends that we're seeing. First of all, gig economy continues to expand and grow. And so in response to that, the gig platforms need to do better and need to continue to have a lot of provide a lot more support to taskers, or in our case, to taskers. And so that means really being more consistent, providing better jobs, providing just better support overall, so that it's easier for taskers to book their jobs, it's easier for them to get between jobs, and so forth. I think the next trend is really the expansion of gig economy in terms of in terms of the types of jobs. So more creativity and more different types of jobs. Of course, many companies are asking employees to come back to work full time in office, and so for a lot of people, that's really difficult. And so they are using their skills, many of their skills, to really get on these types of platforms to be able to really earn income in a different way than maybe they had previously. And then finally, really, and we're seeing some of these studies. There's a study that was just published in Forbes by some folks who have shown that local economies are growing because of these types of platforms. So they are a root and a base of entrepreneurship. So a lot of people start their business this way. So, you know, they may have some skills, let's say they have some skills in being electricians, but they may not have any clients. They haven't done it for many years. They can start this way and then grow and expand their business. And this is definitely something that we're seeing.
What are the most common traits that you see of successful taskers that are on the platform?
That's such a great question. Really, it's being reliable. It's showing up when you say that you're going to show up. It's being on time. It's really working closely with your clients, understanding what it is that they need, and making sure that you're there to help them solve whatever problems that they may have. You know, I have taskers at my house all the time. I just had one a couple of days ago, just for something small, but he was so great. And he noticed a couple other things that I need to help with and fix them on the spot. And that's really something that will make that type of a tasker stand out.
Anya, thanks so much for taking the time here with us today. Really appreciate it.
Thank you for having me.
Certainly. Coming up, everyone, your Yahoo Finance Market Update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
It's time for Yahoo Finance's Market Minute. Stocks falling after that better-than-expected jobs report for December, the 30-year yield briefly touching that 5% mark in early trading. In other top news, Walgreens Boots Alliance rallying after fiscal Q1 earnings and revenue beat the street's expectations and upbeat guidance on the company's turnaround. Cost-cutting measures include closing 1,200 stores over the next 3 years. And Constellation Brands sliding today as the alcoholic beverage company cut its growth outlook for the second time this fiscal year. CEO Bill Newlands noted near-term uncertainty on when consumers will revert to more normalized spending. And in gold futures, an inflation hedge and safe haven shrugging off that strong December jobs report and hovering at a 7-week high. Economic uncertainty and inflation risks with a new incoming Trump administration remain. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. We'd like to update you now on the Supreme Court hearing over a potential ban of TikTok. The hearing is about 90 minutes in. Let's take a listen.
manifesto written by Karl Marx has no First Amendment standing on its own in America, but if a bookstore wants to sell that publication, I don't think Congress can prevent it from doing so.
Well, sorry. Go ahead.
No, I'm fine.
No. I'm good. Okay. So I want to press you a little bit on the distinction, because in Lamont, the prohibition worked directly on the American. Like, you have to specifically request this information that comes. This is working kind of as Justice Kagan's questions were pressing you. This is working on ByteDance. It's not saying to your creators, you can't post on ByteDance. That's indirectly going to happen if ByteDance chooses itself not to permit TikTok to walk away with the code. So does that matter, that distinction between Lamont and this case?
No, for two reasons. One, under the Sorrell case, you look to not just the law itself, but its practical operation. And the practical operation is prevent us from working with ByteDance. So that's one answer. And you bring up Lamont, and Lamont's actually a very important case, I'm sure you all recognize here. It's important to look not just at the court's opinion, but look at the briefing in that case. The government itself never came in and argued there's no right to receive this information. That's the sort of greater argument. All the government argued was, of course Americans have a right to receive this, but it's just not so much of a burden to require them to raise their hand to get it. So Archibald Cox, when he was the Solicitor General, said to the court quite explicitly in the brief, we're not even going to make this argument because we think it's so contrary to history and tradition. All we're going to argue is the burden isn't enough. Now, what happened is the D.C. Circuit kind of turned that upside down and said, oh, Lamont's just a case about the burden. Well, that's because that's the only argument the government was even willing to make in this court. There was no argument that Americans didn't have the right to hear that speech.
What about, so I think this goes to Justice Gorsuch's questions about antitrust divestiture. Let's say that for antitrust reasons, or let's even say not for that. Let's say for suspect First Amendment reasons, Congress tells Jeff Bezos that he has to divest in the Washington Post. You know, he can no longer own the Post. And let's say that neither Bezos nor the Post challenges that. But let's say that you represent clients who really like the Post as it was, who really want to keep receiving the Post, who really want to publish op-eds in the Post. Yeah. Would you have standing? Like, what kind of a claim would you be making there?
I believe so, Justice Barrett. And the court has cited Lamont in other cases in more recent years to say we've recognized a right of American listeners to receive information from others. And remember, even that is a lot. That's only a small part of the argument I'm making on behalf of the creators. You know, I don't mean to diminish Mr. Francisco's arguments on behalf of the company and ByteDance, but the core speech in front of you in this case are the videos and other forms of communication.
That was the Supreme Court's ongoing hearing of a potential ban of TikTok. You can scan the QR code below to listen in on the arguments. We have more on Wealth with Brad Smith after this break.
A new report from AARP Public Policy Institute found that the top 25 drugs prescribed under Medicare Part D have nearly doubled in price since first entering the market. And inflation isn't totally to blame here. Yahoo Finance's Anjali Kamlani has more on this. What did this report find out, Anj?
Well, in fact, Brad, this new study released by AARP yesterday shows that these drugs increase more than inflation, and that's pretty much how the industry has functioned for some time. Then the report noted that there are 25 drugs responsible for nearly $50 billion in total Medicare Part D spending in 2022 and were used by more than 7 million Part D enrollees. It's important to note that these branded drugs have been increasing faster than the rate of general inflation for decades, but most of them, and this is an industry line, that they've been staying under that 10% mark. And so that's supposed to be sort of that sweet medium where they continue to increase the price of drugs, but not so much more every year. Drugs with the highest lifetime list price changes were Merck's diabetes drug Janumet. That was an increase of 293%. And then diarrhea drug Xifaxan. That is by 253%. Medicare has already begun negotiating drug prices for some of these top drugs, and that's, of course, because of the IRA. But some of these, like the ones I just mentioned, have not yet made the list. We haven't seen them. We've seen other blockbusters like what we expect to see in coming years, GLP-1s. Ozempic, which has been the longest on the market since 2017, has a lifetime increase of 43% already in the last 5 to 6 years. So we're likely to see that coming up on the list, and it'll be really interesting to watch that one happen. But as it stands right now, the report itself, not so much a surprise as much as the actual numbers and just looking at how Medicare has negotiated and which drugs do end up on their target list versus the list we just saw.
All right, Anjali, thanks so much. We appreciate that breakdown. Well, also tracking egg prices are surging once again here. The national average price for a dozen large grade A eggs, now $3.65, tick higher from October, headed towards the highs of early 2023, according to the U.S. Bureau of Labor Statistics. So, what's causing this rise in prices? Our very own Brooke DePalma is here with the latest. Hey, Brooke.
Good morning, Brad. The return of the bird flu is to blame for this increase in egg prices. Here you see the return of the bird flu lead to less egg-laying hens and therefore less eggs in the market. And that's what really is driving prices here. If you take a look at the numbers, according to the latest from the USDA, U.S. egg production is down 4% year over year with 3% less egg-laying hens. And that's expected to stick around, these higher prices in this incoming year. You see a professor telling Yahoo Finance that in some of these farms, not only are they losing the hens, but in addition to that, they're losing future generations of egg-laying hens because of the return of the bird flu. And that's what really is making it harder to rebuild their total flocks. Keep in mind, we haven't yet even recovered from what we saw back in late 2022. In addition to that, holiday demand also influenced prices here and caused them to rise. Now, we could see a bit of a break post-December, but then come back once Easter comes around. We'll then see an increase in demand yet again. But one good thing here is that there is decreasing cost of food. Think corn, think soybean meal, and that's really good news for these producers when it comes to their margins.
So we're seeing lower production but improved margins. What does this mean for egg producers and investors as well, ultimately?
Yeah, so the ones that aren't getting hit by the bird flu, they're doing really well here. One expert calling it a seller's market, essentially comparing it to the real estate market. Because if you weren't hit by the bird flu, well, then you're the guys to go to. And that's good news for the largest U.S. egg producer, Cal-Maine Foods. And what we're seeing is them do really well in their last quarterly report, their Q2 results. They beat estimates. Revenue increased 82% year over year to $954.7 million. Net income also came in higher at $219.1 million. And as egg prices really have jumped over the past year, we've then seen Cal-Maine stock react to that. In the last year, investors really flocking, so to say, to Cal-Maine stock. It's up nearly 90% compared to a year ago. One analyst saying that if you didn't get in already, you might have missed the train. And if you do jump in now, you might be in for a bad ride. But another analyst telling Yahoo Finance that perhaps there could be still some upside, about 10 to 20% here. So really it remains to be seen. If egg prices decrease, we could then see Cal-Maine stock take a bit of a hit. But right now, experts telling Yahoo Finance they do expect these egg prices to remain elevated, at least in the near-term future.
Brooke, thanks so much. Man, how did you get the egg beat? Like, my goodness.
Honestly, I kind of like it. It's relatable. Everybody's talking about it.
It's true. Yeah. I mean, it's on my desk every day.
Right.
Yeah, in a different form. Anyway, thanks so much. Appreciate it. Mortgage rates increasing for the fourth straight week, according to Freddie Mac, inching closer to 7%. The average 30-year fixed rate is 6.93%. Here with more on the housing market, we've got Sean McPeak, who is a licensed real estate agent and team lead at Serhant. Great to have you here with us in studio.
Brad, thanks for having me.
Absolutely. So mortgage rates climbing. Where are you seeing the 30-year fixed rate by the end of the year? What's your projection there?
I'm seeing it being brought back down below 6%. I think the sweet spot for us here in New York would be around 5.5%. I don't think that's going to happen, but I predict around 5.8% to wrap up the year.
What needs to happen for that to actually come to fruition?
I think the Fed needs to cut rates more, and I also think that the pricing of risk into the market also needs to be factored in order for that to happen. And I think economic growth is going to help that.
Are your clients sounding like they're anticipating sweeping cuts from the Fed, even as the latest data that we've seen this morning now is looking at a CME Fed Watch probability of us not seeing a cut until late this year, the back half of this year?
I think everybody has the grass is greener on the other side syndrome. So I do think that everybody is holding with bated breath. However, there are deals to be had in the market right now. If you're finding the right situation, you can negotiate fantastic deals with great concessions.
What do you think is going to happen in order for us to see better conditions, lower prices here, and your thoughts on the housing market recovery more broadly?
I think you are seeing a lot of better conditions for buyers right now. In a lot of states, it's either the market has cooled off or there's been an influx of inventory in some of the larger urban markets and some of these middle of the country type states. So I do think conditions have improved. However, certain markets like New York City, where there's a lot of regulation and very high cost of labor, we are seeing less supply coming to market, which is also kind of keeping prices propped up.
What are you seeing as the most persistent risk right now to the housing market? And perhaps it is what you just mentioned and ended on, which is prices and affordability.
I think prices, prices of materials, labor costs, regulations, and then just the overall economic outlook. The job numbers, I think there's a little nuance to some of these numbers. What type of jobs are people getting? What type of jobs are people losing? I think there is a little bit of stagnation in the white collar category, which would be primarily my market.
Interesting. You mentioned as well some of your biggest risks, regulations on building and zoning, and it seems like there's more of an appetite that's brewing right now among the incoming administration to try and open up some of the public lands for building. I wonder how you look at that from the perspective of a person that has continuous talks with people who are looking to buy existing homes and what that could eventually mean as well if there is more supply that comes online.
Well, I think a natural infusion of supply is going to help the buyers and stabilize prices more broadly. So, but it's not like an oil supply promise, right? We need actual supply in order to stabilize prices and to have options and people to shop around and look in different markets, different neighborhoods, different territories.
Help our viewers out. What are 3 tips that you have for those who are, getting there in New York at least, getting their big puffer jackets on, going out and doing some home shopping this weekend?
I think go look at some of the houses that have been on the market for a long time. So the days on market don't necessarily need to be brand new. Some of these properties languish on the market because they do have poor marketing, they have bad photos, maybe they have a wrong data point.
It's that simple, just bad photos? Look for the listing with bad photos.
We live in Instagram, Pinterest, Architectural Digest type of world. The buyer has a much more discriminating eye than they did in 2010.
That's a fair point. You also talk about limiting viewing to less than a certain amount of houses per day. What's the sweet spot there?
I think 6 is the sweet spot, but if you really need to see 8, I think after a long day of shopping for houses, that it all kind of blends together and you become fatigued, and it's really mental fatigue. So I think that 6 is about the sweet spot. You don't want to go too much further than that.
And so lastly here, what about collecting your own documentation when you're going on these visits? What you should be doing as you are collecting your own data?
I think My personal practice is to take a picture of the address of the house and then take a couple photos inside to remind you of what you like, what you didn't like, maybe there's some defects, and just almost use that address as the cover of your photo album on your phone, and use the rest of the videos and photos you take just to kind of remind you of what you liked, what you didn't like. And the listing photos can be, they're made for marketing. They're not made for necessarily your education. So it's good to have these things referenced back when you're doing your research.
All right, well, fortunately for me, if I forget to take a photo of the address, there's at least geotagging within my iPhotos on my phone as well here.
Yes,
Sean McPeak, thanks so much for taking the time.
Thanks for having me.
Appreciate it. Coming up, everyone, we're taking a look at how you can build and when to cash in on an emergency fund. We've got all of that coming up. We're checking in on a trending ticker on Yahoo Finance as Airbnb is committing to helping 25,000 more people impacted by the fires in California, including survivors, evacuees, first responders, and firefighters. This announcement comes after the company said it was partnering with the government organization 211 LA to offer free temporary housing in the Los Angeles area. Currently, about 180,000 people have been evacuated as 5 wildfires burn across Southern California. According to Bankrate, as of 2024, 27% of Americans don't have an emergency fund, the highest percentage since 2020. If one of your goals is to start building those emergency funds, we are here to help. Lawrence Sprung, Midland Financial founder and author of Financial Planning Made Personal, joins us in studio. Lawrence, great to have you here with us. So, as you're trying to build an emergency fund, where is the right place to start?
Yeah, so you have to figure out what the amount is that you need or want for the emergency fund and then start budgeting for it. Create a budget that includes a monthly amount that's going to go towards that emergency fund until you've built that up.
So how do you go about the calculus and making sure that you are coming to the right conclusion of what that number should be?
Yeah, so that's different for everybody, and depending upon your life facts and circumstances, you'll really want to look at that for your personal situation. For example, if you're in a role that you know if you lose your job tomorrow, you can replace it very quickly, then you can essentially be on the lower side, maybe 3 to 6 months. If you're self-employed and worried about the ebbs and flows of your business, you might need something in the range of 12 to 18 months, depending.
And so where should it be deployed towards as you're thinking about what you've saved up, and then what the first items on that checklist should make sure that they're accounted for if you do need to tap into that emergency fund.
Yeah, so I would start with setting up a separate account where you have what that goal amount is set aside in your mind or on paper or part of your plan, and then start allocating money into that account each month. And typically high yield savings accounts, high yield money markets, those work really well because it gives you a higher rate of interest than you're going to get from the bank, and it's immediately liquid. So if that emergency rises tomorrow, you can tap in, get that money without any penalties or hassles.
A bank rate study from 2024 found that 38% of Americans were willing to go into debt for discretionary purchases like travel or entertainment. What's more of a risk here, taking a credit card balance or dipping into that emergency fund?
Yeah, so I think, definitely taking that credit card balance. If ultimately push comes to shove, you have to access that money, you're better off dipping into that emergency fund. Hopefully you refill it before your next emergency arises, because then you might need to dip into the credit card balance. But you have to be able to, be flexible with your planning and understand that, just by taking out of the emergency fund and not going to the credit card doesn't mean that you've solved all your problems. You still have to plan for that emergency.
All right, I'm hoping that people don't have to pull a Brian McKnight and start back at one, but if they do have to tap into that emergency fund and then start over and rebuilding that, what are your tips for starting over?
Same thing that you did when you started out. Figure out what that emergency fund amount should be, create how much you can put in on a monthly basis, and start socking it away in that separate account until you've reached that amount that you've set as your goal, and then you're back in business. And then once you've hit that goal and it's tapped out, you can then reallocate those monies to other places in your budget that might require them.
Generationally, rather, how does the emergency fund planning shift as you are later on in life versus earlier on and just doing some larger planning of how you get started?
Yeah, so I think earlier on there's a lot more risks, right? You can have a risk of losing a job, you have a house. As you age, maybe you don't have to be worried as much as about your job because maybe you're retired. Maybe it's now just looking at the emergency, a roof issue, a plumbing issue. So you could substantially lower your emergency fund at periods of time. So it's something that you have to look at based upon your life facts and circumstances.
Lauren, it's always a pleasure to grab some time with you. Thanks for joining us in studio. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it.